How's everybody doing this morning? Hey, can I get a sound check out there? I'm having a little bit of problems with my audio. Kim or John, can you guys hear me? Can you hear me? Are you able to hear me? Or is it just my system? Do I need to start this whole thing over again? Audio's good. Could you hear the startup, John? Could you hear the music and everything play at the beginning, or was that quiet? Kim says you can hear me. Okay. What about the startup? Did you hear that startup when we started up? Did you hear all the music that plays with the startup thing, or was that quiet? All right. You could hear it. Oh, all right. So I guess everybody's working on their end except for me. Okay. Well, that's good then. I can hear myself, and that's all that matters. We can hear that everything is working. So good. Let's get started. My name is Lan Turner, and I am the finance instructor down at Utah Tech University for the continuing education department. And we are having summer school. And for those of you who want to join and come in and hang out with us while we talk about the stock market and the futures markets and the different markets, come and join, subscribe. Everybody's welcome. Nobody's restricted from coming to these live online classes. And we just continue to watch the markets together and review a little bit of the things that we learned in class. And so today I want to talk a little bit about the RSI versus the MACD indicators. I think that it's nice to use some of the mathematical models and to learn a little bit about them and how they work. And so I thought we would just go through, talk about RSI and MACD and tell you a little bit of differences between the two and the importance of the two. And then we will go through and look at the markets. We've got our portfolio that we need to review. So we've got our class portfolio, a bunch of stocks that are in there, and there's a bunch that we need to make some trading decisions on. We need to sell some, we need to buy some, we need to get some more money into some, we need to get some money out of some. So let's go do that today. So first, let's start off with the MACD. All right, so let's close down this little jillywig here, and we'll come right back into, and we're going to go right into our decision point trading. This is your slides that you get out on the web. And those who have been coming to class know how to get that. Let me go ahead and show those who don't. You just go to www.sfomagazine.com and then you just type slides.pdf. All right, and that's how you get this document. No, you don't have to give me your email address. I don't want us to be sending you emails. It's free. You just go out and get it and download it because it's part of the class. And we just go through the class. Oh, I have to tell you about the scammers and alerts today. My own son got caught up in the scammer profile. There's one on Facebook that he got caught in. There's one on Facebook. There's one on Twitter that are fake people trying to pretend to be me so that they can get you to sign up for them, and then they try to sell you stuff and try to tell you that they will trade your money. And it's like, oh, Lan Turner says he'll trade my money. If all I have to do is just send him $10,000 and Lan Turner will make me rich beyond my wildest dreams. These are not me. All right. And I've reported them to Twitter and I've reported them to Facebook, and Twitter and Facebook won't take them down. So you know how that goes. So they think maybe I'm the fake one. So that's the way it works. Be aware. I do not ever ask you to send me your information or your phone number. I already have your information if you're a student at the university. So I don't need to. I'm not asking you for your information over Facebook. We do have our own Facebook group. And so that is a Facebook group that you can join, but it's not, it's the Trade Mentors Facebook group, and you can join that. I know I'd encourage you to do so, but I'm not going to ever ask you to send me money or anything. I rarely even, why would I even ask you to send me your email? I don't need it. I got it. All right. So don't fall for these scams. All right. Please don't fall for it. My own son fell for it. All right. The best time to start investing was last year. The second best time is today. So there's been a lot of opportunities in the past, but we cannot mull around and look at the past year and say we missed it, and so let's not trade. Let's get in there and start figuring this stuff out. There's always opportunities in the market. All right. So let's see. We're going to come down here and we're going to get to where is our, let's see if I can go a little faster. Let's go. Here we 2, 3, 4, 5, 6, 7. There it is. Okay, there's Mastering the MACD, a trader's guide to momentum. All right, so this is the MACD, and Gerald Appel is the guy who invented this thing, and he invented it back 40 years ago. He's also founded a little newsletter that he did in 1973, which is in its 46th year of publication. I don't know if it's still doing that. They say that it's still in its publication. That was on Wikipedia. I grabbed that from, but we'll see. An approach to technical analysis is rigorous, quantitative, and systematic validation by long-term historical studies. So anyway, that's Gerald Appel. I got to talk to him on the telephone one time. Never met him in person, but I did get to talk to him on the telephone once. And Mastering the MACD, a trader's guide to momentum. I was introduced to him by one of my other instructors out of the Chicago Board of Trade, and we sat and had a nice conversation, who actually worked for the guy. And so he called him and introduced me and said, hey, here's a buddy of mine. Just wanted to meet you. So it was nice to be able to talk to him. He was pretty old back then. All right. So the anatomy of the MACD. Now the MACD is this indicator that sits at the bottom of your chart. And I've got this little tool in here, and there's several settings in here. There's one called the standard default setting, and that's generally the MACD is 12, 26, and 9. And you've got also, there's different versions of the time frame, but it's a 3 moving average system. So 18, 17, and 9, and then this is a 5-minute to a 15-minute chart. And then on your ballast trading, this is what we call aggressive or scalping. We make it a little bit tighter, a little bit faster. You can use it during the day, 5:35.9, 5:35.5, and you might want to put that on a 1-minute chart like that. Okay, so you got some settings in here in this document that will kind of remind you what to do. But we've got the calculating the MACD is a 12-period moving average. It's the fast moving average, and a 26-period, which is the slow moving average. And most of these indicators that you see at the bottom of your screen, most of them are just some sort of moving average. Just kind of keep that in mind. And then they'll turn them into, lines like this one, or this one also has a histogram. So you use a combination of the two. And it's just whatever kind of makes you feel more comfortable to see them. But you see that we have the crossovers, and these crossovers are kind of when the market has a tendency to start to rise in price or fall in price. And that's really what it's trying to do. It's like moving averages that you would lay over the top of your chart. You can do the same thing. You could put a couple of moving averages on the top of your chart, and that would also have that same basic effect, but he puts it down in the bottom window and combines it with the histogram. All right, and so these are the signals. So rather than tell, let's go show. All right, so we're going to come back over to track and trade, and you can see down here in the bottom window, I generally always have RSI and MACD turned on. Now I also have momentum turned on. I have it on very quiet. You can see in the background I have momentum, and it's the little black ones down in here. And maybe on your screen it might be a little bit hard to see, but I kind of put that back in the background just so I can see a little bit of a difference between momentum and MACD. But that's just me. All right, so we'll remove that for now. And so what we're looking at is we're looking at the two indicators, and I'm going to take off RSI, and we're going to remove that one. And this is just the MACD. And you can see in track and trade, we have quite a few settings in MACD. We've taken the MACD and we've built into it a number of different ways of looking at it. So here's your 12, your 26, and your 9. All right, so 9 is what we call the trigger line. That's this line here, and it's when it crosses over and above the histogram. Now, a lot of companies, a lot of trading platforms will put 2 lines in there, but one of the lines works on both the histogram and on the line. So there's not really it's duplication. You have 2 of the same thing. So we don't do that in here just to keep it simple. We have the 3 lines, which is really all there is, but there are 2 of them one of them is part of the histogram and one of them is the line itself. So you can see the crossovers down in here, and this is what the crossovers would be. So right here and right here. So those are your crossovers, and as long as that market's going up and it's underneath the other line, so you can see the histogram line is above the trigger line. So when it crosses below the trigger line, that's when you get this crossover that you see over here drawn in 2 lines. So like this. So the histogram line is actually that blue line, and it's kind of drawn funny over here because they're using a different formula. And then you have the MACD line, which is the trigger line, which is the 9, the shorter period right here, the longer period. So that's how this goes. All right. And that's the trigger line in the MACD. So that's all there is to it. It's very simple. And you can see when you look at how this works, you can see that the market has a tendency. This is where it crosses right here, right? And this is where it crosses right here. And so you see the market has a tendency to rise right here and fall right here. So that's kind of your trend that it's pointing out from low. And so when you use the trigger line in combination with the histogram, it's just a real simple way of looking at the same thing. This is just kind of a little bit different view. Some programs use it like this with the two lines. This is the way he initially designed it, just a two moving average with a little histogram underneath it. But the two lines in his math, there's really only three lines. There's three lines, right? There's 12, 26, and 9. So you don't need four lines. You don't need four. That just makes a little bit more complicated to look at the same thing. So we just take it and we do in track and trade, we do 12, 26, and 9. There's your three lines, but we make that one, that's the trigger line. All right. So just a little bit different look than what you see over there on the diagram, but it's the same thing. So there you go. That is your MACD. Now there's something that you should be aware of about the MACD. When we are trading and we're looking for an entry into a nice long position, this is where you want to see it, down below the histogram. So the histogram is the horizontal line that goes across through the center like this. So anything that's down in here is considered bearish, and anything that's considered up here is considered bullish. And so the market is rising, so it's bullish here, but it's on the down slope on the bullish side. So this is turning negative. So that's why the price bars up here are going to be red, and then the MACD turns red. All right. And then once it starts to fall back down in here, it's past the equilibrium. So this is the equilibrium where it's turned, and then it started to go green again, started to go back up. That's where you see the combination of the lines. And so it's just really it's really just a confirmation of what you see going on in the chart itself. So if you're looking at the chart and you're like, well, I wonder if that's going to continue, you can look at the MACD and you can say, well, the momentum of the MACD is showing that we should continue the momentum back up from this little turnaround point right here. So you can see, because it's starting down underneath the 50% line, or the neutral line. Okay, so down in here, this is where we're looking to buy, right? Buy low, sell high. So this is how you do your timing. So you time it so when the red bars down in here turn green, that's kind of your little indication that the market is changing from bearish to bullish in a buy zone. So anything down in here, right, you can see that this is kind of where this histogram line would be if you were to draw it right over the top of the chart. So that's really what's trying to be done here, is it's trying to take this market and put it on a scale, on an average scale, so you can see when the market's below the histogram or the average line, and then when it's turning and changing color. So it's changing colors, but you can see that the histogram line is below the histogram changing colors. It's not changing colors above the histogram. That would be turning the market bearish and turning it down. So that's where we want to come in and look at the MACD. Now, when you're trading, you want to kind of look for the market to be coming into this zone right here. And when you see this, this is where you want to take your long positions. Right here is kind of a classic position to be getting into the market long. Right? Another one right here, you can see. Of course, this one was a real nice one, and it took off and went quite strong up into the other region. And then you can see where it ended right here. This is where the top of the market is. And so when you seen me do my trades, and I got into the S&P 500, and you remember it was not too long ago where I rode that market way up to the very top, and then I was like, okay, I think the market's topped out. I don't think it's going to go any higher, and I bought some short positions, made money on the way down. Well, I was looking at the MACD, and I was saying the MACD has gone way up into the upper region. It's turned green, and now it started to turn red, and I'm going to take my long positions off, and I'm going to start buying short positions. And then it started to come down, and when it came down and got down into this region here, down below the histogram, and turned from red to green, that's when I took my short positions off. Right? So you can see right in here, this market came in and started to make that little green zone in there, but it was still red on the MACD, and it was still below the trigger line. So I didn't want to get out until it had crossed above, and I wanted to get out when it crossed above, down below the center line. So that was what helped me make my trading decisions based on that MACD, and now you can use it too if you haven't been using it. All right, so that's how we do that. And now we're going to come in and we're going to look at the next one. And so we'll come in and look at the next one. And the next one is the RSI. And I want to talk about the RSI. And then we're going to go through and we're going to look at all the charts that we have in our portfolio, and we're going to apply these RSI and MACD. Now, there's a couple other little component pieces to this I want to show you, but I wanted to show you the MACD, but I want to show you the RSI first. Then I'll swing back to the MACD and show you something else. All right. So this is mastering the RSI, and the reason I pick MACD and RSI is because they're probably two of the single most popular indicators in the entire world. And now these two indicators in the financial markets, when we trade, we consider the financial markets to be a Me Too market. All right, a Me Too market. What's a Me Too market? A Me Too market is the trend is your friend until it bends or ends, right? So a Me Too market is a market that's saying, hey, I want to get into this thing when everybody else is getting into this thing. And when everybody else is getting out, I want to get out. So how do I know when everybody's getting in, and how do I know when everybody's getting out? Well, everybody looks at the same indicators. And so they all start to buy at roughly the same times. And that causes a trend. So me too, get me in. I want to be in. Now, there's also some counter trend stuff that we do. There's accumulation and distribution, and we like to follow the big players, and the big players buy on the way downs and sell on the way ups. Most retail traders, they sell on the way down, they buy on the way up. So you have to take all that stuff into consideration and not just say, oh, Land's saying I should buy here and start to buy, go up, and up. But the problem is that we as small speculators, we have a harder time doing the accumulation distribution model because we're so small, we can't accumulate very much unless we're using, sometimes we can get into a market that has smaller share size, or we can have fractional shares, and that helps us a lot. That's a really good thing. And so we can use fractional shares to do the accumulation. But a lot of these stocks, as you see, they're very expensive. This is a 300 Apple. If you want to get into Apple, it's a $300 stock. So one purchase is $300. And for small speculators, oftentimes one share is too much. They can't afford that, or that's the only thing they can buy. They put $300 in the market, and that's still not even enough to buy one share of Apple. So to do the accumulation stage is a little bit more difficult for small speculators. That's why, the fractional share trading is a lot better. When you have fractional shares, you can do the accumulation process a little easier. But when you're trading larger share size like this, we're going to look for the more optimal opportunities to put our money in the market rather than just buy all the way down a downtrend. But it's nice to be able to say, okay, if I'm going to put my money in here and it keeps going down, I'm not going to just back the truck up and put everything in just because I get a signal from the MACD. Maybe I'll do a little bit and then see if the MACD doesn't keep coming down, or the market keeps coming down, and I can do a little accumulation. But if you read the MACD and the RSI together combined as a tool, it helps you try and time the bottoms of these markets a little bit better and start doing your accumulation down in here. So you don't start doing an accumulation at the wrong time zone or the wrong place. Right? You wait for the right opportunity. And they also work very well with options. So when you're getting ready to buy and sell options, you want to sell some options premium. Well, you want to be in a zone where the market is more likely to turn and go back up if you're selling options down below the market to collect premium. All right. Or turn and fall if you're selling options premium above the market. Okay. So we want to take that into consideration when we're making these changes in the market. So as we come back over and we start looking at the RSI was created by J. Wells Wilder. Now, J. Wells Wilder is probably one of my very favorite technical analysts in the whole world. I like this guy. I like almost everything he's done. He's really super good. All right. I like him probably better than any other analyst. Now, J. Wells Wilder was an American mechanical engineer turned real estate developer. Interestingly enough, he was in real estate. But he is best known, however, for his work in technical analysis. Wilder is the father of several technical indicators that are now considered to be the core tenets of technical analysis software. These include the average true range, which is the ATR, the relative strength index, which is the RSI, and the average directional index and the parabolic SAR. So those of you who follow around and watch me in these YouTube classes, you'll notice that my three core indicators are the RSI, the ATR, the little yellow dots on track and trade, and then the parabolic SAR, which is the red dots. So the blue dots, we'll oftentimes use the blue dots. I call them the blue lights. They are a derivative of the red dots, which are the parabolic SAR. So it's just a different hyperbolically linked mathematical model that moves those parabolic SARs around. So we call them the blue lights because it's a different math formula than what Wells-Wilder did with his parabolic SAR. But Wells-Wilder is what we took from to create that blue light system in the bulls and bears. It's just a different way of mathematically calculating, the same concept or the same idea. So gives you a little bit different answer is the whole idea. So that's the core tenets of my trading strategy when I'm looking at the mathematical models, of course, along with the MACD. So and it's not that we're relegated to just those indicators, but those are the core. Those probably 90% of everything I do with mathematical modeling of the markets is done with Wells-Wilder with his models that he used, and then the MACD. So as we come through the MACD or the RSI, as you take a look at it, one of the most important things about the RSI is that it's based on a 0 to 100 scale. Now, why is that important? It's important because the RSI tells you when a market is overbought and oversold. So let's come in here and turn on the RSI, and we're going to turn off the MACD. So we're turn off the MACD. So there's the RSI. Now the RSI is coming down, and you'll notice that it has, and let's turn off this center one just for a second. We're going to turn off that one. This is the classic RSI. So you've got 70 to 30 as our markers. Those are our general rails that we have that go across the market. And anytime the market or this line, this moving average, goes up above 70, we consider the market to be overbought. All right, overbought. So that means that too many people have bought it. Now, I want to also mention to you that one of the best signals that you can get is when it breaks out of the center zero line, or this is just the neutral zone. Okay, so for the RSI, anything between 70 and 30 is just considered neutral, and the market's probably just going to be going sideways. Okay, not a lot of trend action in there. It's kind of it's in the decision mode. But you can see from the RSI whether it's rising in price or falling in price from past performance. Where's it been? So it's been way high and it's coming down. Well, it's in the neutral zone of coming down, or it's in the neutral zone of going back up. But oftentimes one of the very best signals that you can get is when this market actually breaks out of the neutral zone. So like right here, you can see it's getting ready to cross above right there. When that zone happens, that's oftentimes a really good place to be getting into the market right there. But when this market starts to go up into here, it starts to get tired up in there. And then usually when it breaks, that's oftentimes when we're getting to the top of the market. Now, it can stay up here for a long time because it's based on a 0 to 100 scale. So it can get up there, and you can, as you can see in this example, it goes up there and it can stay for a very long time up in there before it breaks and turns and starts to come back down. So just the same thing as if this is a good place to get in on the way up, when it breaks out of the 170, it's a good place to get out when it breaks back into the 70. Now, oftentimes we'll try to do a little bit better than that and get out of the market before this is already breaking into 70. We want to be out up in this region here if we can. And that's why we use it in combination with the ATR, which is also, remember, that's the yellow dots that we use for our trailing stops. And if you remember, those are also written by Wells-Wilder, same guy. So the same guy wrote these yellow dots that created the RSI. And that's why he uses them, one in combination with the other. So the RSI is coming up here, and this is where it breaks, but it breaks right where the ATR crosses over as well. So as you can see, this little crossover right here is almost identical to the location of where the market's coming back down into the 70. So you can see right up in there, right in here. So you can see the break up in here, right in here, down in here. You can see how it corresponds right in here. So you can see the two tools were designed to work one in combination with the other. And so that's why I really like those tools. They work really well. That's why I like them. And so lots of people like them. Lots of people use them. And so that's why we call it a Me Too market. And that's why they work. It's oftentimes, self-fulfilling prophecy is what we call it where the market does what we expect it to do because there's so many people that believe it, that's what we believe it's going to happen, right? If you go to Utah, you can kind of just anticipate that the town is going to be very quiet on a Sunday morning. Nobody's going to be walking around and going shopping and stuff. Why? Because in Utah, it's very common for most people to go to church on Sunday. Well, I can predict that by having seen that happen over and over and over and over and over again. Self-fulfilling prophecy, right? We all do it. Everybody in Utah does it. So I can predict the future by saying next Sunday, it's going to be really quiet in the morning. That's self-fulfilling prophecy. We make that happen. And so that's what these indicators are, is they oftentimes will predict the markets based on self-fulfilling prophecy. Because the indicator is there, we all jump in, and we all jump in because the indicator is there. Okay? So it's kind of, does the dog wag the tail or does the tail wag the dog? I don't know. But that's how it works. And so you just, me too market, get me in. I want to get in. Everybody else is getting in, so I'm going to get in too. And if everybody jumps in and pushes the market up, well, we all ride along until everybody starts to get scared. And so the name of the game is to get scared before everyone else and get out before it flushes and you lose your money. That's the name of the game when you play this way. All right. So you can also do the accumulation distribution, which means you buy all the way down and then you sell all the way up. So you're buying, bringing your average cost down. You're selling all the way up. And that's how you get in and out. So there's different types of trading and different methodologies. And you guys all know me. I'm very big into the accumulation distribution model if you can do it. So sometimes you can't do it because again, depending on the depth of your account balance and the ability to buy as markets are coming down, so you can build a strong foundation. This is accumulation, and then this is what we're talking about with buying low and selling high. You just got to be able to panic before your entire upside down pyramid turns into a loss. So this is the process of reading these charts. Now, this lower region again is called the oversold region. This region up here on top is called the overbought region. Now, there's something that these two indicators do that are different than each other, in the sense that this one is based on a 0 to 100 scale. So when I said that the market goes up and it hangs out up there in the top, it can do that for a long time because the market can go up longer than this indicator can continue to go up, because it stops out once it gets to 100. So this is 70, and that's just a breakout point, just time to get in. Well, by the time to get out, it's hung around up in there in that top region for a long time before it turns and starts to fall down. It can't go any higher. That's as high as it can go because it's on a 0 to 100 scale. So you got to keep that in mind. It's a scaling issue. Now, I want to show you something. Let's get rid of all the drawings here. And I'm going to move this chart back and forth. Hold on a second, losing my voice. All right, get the hot tea going. Okay, so this indicator being on a 0 to 100 scale, if I slide it, you'll notice that it's not moving. All right, the high highs stay high and the low highs stay low. Low lows stay low. See that? It's just a solid line across there, and it's going to always be above 70 wherever that thing gets scaled to. Notice the upper chart is scaling and moving and changing based on where we slide that thing to. But that RSI is just as solid as a rock. Okay, recognize that? See how that works? Now, if you're using an indicator, if you're using a chart, hold on one more time. I'm going to try one more. If you're using a web chart, a chart that doesn't give you the ability to go back in time, you're not going to see this, which is why it's important for me to show you what's happening on a real trading platform. All right. So if you come in here and you remove and you add the MACD and you remove the RSI. Now the MACD, it is on a relative scale. It's not on a 0 to 100 scale. So there is no top to the MACD. It can just keep going and going and going. So don't think, oh, it's at the top, it's going to turn and fall. That's the way we think about the RSI. Not so with the MACD. MACD is on a relative scale. So watch this. As it moves, watch how it rescales in the window. All right. See that? Oh, look at that. It was at the top. There's the top. See that? It's right at the top. So you're thinking, oh, it's going to come down because it's at the top. Oh, but look, it's no longer at the top. So as you scale it, as you move the market across, it scales inside that little window. Okay. I don't know if you can see that, but that the RSI never moves, but the MACD does. So watch this. Okay, there's a good example. Look at that MACD. Look at it rescale. Now again, if you're just looking at some cheapy website chart, you'll never know that. And that's an important thing to know and understand. Because as the market starts to move and starts to trend larger, it's going to push all of your history or all of your future. See how that we start getting a big trend? We think we're, oh, that's MACD's. It's really way down there. It must really be a strong trend. But then as the market really grows, and look at this, look how tiny this little thing became against this one here, and the MACD does this. Now, is that better or worse? I don't know. It's just it just is what it is. It's just how Gerald Appel created it. It's based on a now when he was doing this, he did it by hand. Didn't have a lot of computer work. I mean, that came later. But back in the 70s, we didn't have computers like we do today. This has all kind of been redeveloped and put into the software, and the way Gerald Appel's formulas turned out, and the way both these guys, J. Wills Wilder. I think J. Wills Wilder is still alive, but Gerald Appel, he's long gone. But these guys invented these things clear back before we had computers, and so the different concepts were done on paper. So I don't know if Gerald Appel I'm sure he did. I'm sure he realized it. He's a very smart mathematician, but he was not on a 0 to 100 scale. Obviously, he knew that he was doing that, but that's the nature of it, and that's how it turns out in your computer screen. So realize that just because it's at the top here, that's not the top. It doesn't have to be the top. It can keep going higher. Whereas the RSI, on the other hand, can't. It's set on a 0 to 100 scale. Now, that said, those are the kind of the basic structures of the RSI and the MACD. MACD, when they get up here and they start to roll over, you got the trigger line. It's underneath. As long as the histogram is above it, you're good. You're good to go. And as soon as it starts to cross over, you have two indicators showing you here the colors and the line. The colors and the line. Okay. So that's where you're going to know that you're in an uptrend versus a downtrend. And generally speaking, we'll buy as long as the histogram is above the trigger. But as soon as it falls below the trigger line, or in this case where it goes from yellow to, see, the thing is you can have the trigger line like right here. This is an example where you can have the trigger line still be below the two red bars, so you still stay in the market. But as soon as the red bars fall below the trigger line, that's where you want to say, okay, put a fork in it. This thing's over. Now, when you were day trading, it's very common for day traders to stay in a long position or a long trend. Like, let's say this is a 1 minute chart, then you would stay in until here, and then once it turned and rolled over, you wouldn't trade anymore because you're now in a downtrend, right? You're not going to start trying to buy in this zone here until you get back into a zone here where it crosses back over and it's back above the trigger. So anything above the trigger, you're going to take long positions. Anything below the trigger, you're going to be taking short positions. All right, so that's how that works. Now, I want to show you something else that's very interesting about these tools. Now, we're in a situation right now where the market is making higher highs. So we have a high here, and we have a higher high here, and a higher high here. But yet in the indicator, we got a high here and a lower high here. So look at the name of this indicator. Moving averages, which is what we've been talking about now. The second half of the name of this thing is convergence and divergence. Convergence and divergence. Now, a lot of people interpret this as the two lines coming together and separating. And you could think of it like that, but that's not really what the convergence and divergence is. So when you look at the little placard over here, and we look at this, a lot of people will interpret the convergence and divergence, this line right here, of being far apart and coming together. And you can think about it like that. That's a little bit of you know, the strength of the market moving through its trend, the convergence and divergence, but that's not really what Gerald Appel was looking at when he was talking about the convergence and divergence. He wasn't talking about the width of the two moving averages coming together and going apart. What he was looking at, as he noticed in his mathematical model, is that you would get higher highs in the market and then you get lower highs in the trend or in the indicator. So you can see that this is lower highs while we're getting higher highs over here. That is your convergence and your divergence. So if you're getting higher highs in the market and you're getting higher highs in the indicator, that's the indication of a strong uptrend, and that would be convergence. Convergence. So you're getting convergence between the two. They're doing the same thing, like porpoise. But when you get the divergence side, you get the higher highs in the market and the lower highs in the indicator, that's divergence. So you're not getting them, they're not porpoising, they're not doing the same thing. One's going up and the other's going down. Well, what does that mean? That means that this market is losing strength mathematically calculated, all right, mathematically thinking. So this is getting higher, but the math is saying it's getting weaker. So what we generally anticipate is that this will be the top of a market, that it will turn and flush from here and come back down and start the new downtrend. All right, so this will be a place where this higher high has a lower peak on the indicator than the previous peak, which was lower than this one. This is losing momentum. And that's why I oftentimes will come in here and turn on the momentum. And I can see in here that we're losing momentum. See that? That's why I use the momentum indicator to kind of help me see that a little bit better. It's a little cleaner because it's mathematically calculated for nothing but the momentum. This is just a momentum indicator. But it's not quite as good at telling you the swinging, sloping moves of the actual market itself as the MACD is. It doesn't have this little, see the little switch from green to red? I really like that. That's really neat in the MACD. The momentum indicator doesn't have that. But you can see the momentum indicator, see how it's losing its momentum as we come up into the top of that thing? The mathematics are saying, hey, this thing's dying. It started to die right back in here. You can see momentum started to lose its power. But yet MACD was still coming up and showed you where it was actually going to drop right in there. So that's why I kind of hide the little momentum in there. Sometimes I'll put it behind it because I want to see, or I grab it like this. You just move those little tiles and you see how I put it behind there. And then I can see where the little momentum pops its little head out back there behind there and shows me, hey, it's a little bit stronger to the downside than what MACD is showing you, or it's a little bit stronger to the upside than what MACD is showing you. So I can see that those little outstretching outposts on the momentum, and that's why I do that. So what we're looking for is we're looking for divergence and convergence. Now in the RSI, when you come to the RSI, you have that same effect. So you turn on the RSI, let's turn off the MACD, and you get that same effect. You get a lower high in the market. Now it's not quite as prevalent and it's not quite as well known that that's what you're looking for, but it's still there. And a lot of more advanced traders look for that. They look for the high here and a lower high here and a high here and a higher high here. That's telling us that the strength of this market is starting to weaken, even though it's got higher prices. Now, does it mean that the market's going to flush? Not always, but it's a mathematical model and it has a tendency to work quite well. In fact, it worked well enough that MACD or Gerald Appel named his indicator after it. So that's why it's the RSI, or that's why it's the MACD, moving average, and then it's convergence divergence, MACD. So he wanted to make sure that you understood that he also looked for the convergence and the divergence of the indicator versus the market. Now RSI is just the relative strength index, so it shows you the strength of the market. The strength is rising or falling, but it still has that same convergence and divergence in it, component to it, because it's just part of the mathematical model, and that's what happens. Okay, so there we go. That is pretty much a pretty tight rundown on those indicators and how they work. So this little sketch here for you, I had AI make that for you, and it turned out pretty nice. And so we've got this one here, and I put those into your slides. And so you can have those to remind you of your settings. It's pretty easy. Most of the settings are, most of your settings are the defaults in track and trade. But you can see down here, we have the recommended thresholds, ranging markets, overbought region 70, 80, 60, and then oversold is the 30, 40, 20. So you can kind of look, you can move that little envelope up and down, of course, obviously. Make it tighter if you want, or looser if you want, depending on your own strategy, depending on what you want to do. Okay, so that is the two indicators. So now what we're going to do is we're going to go through our portfolio, and this is our YouTube portfolio, and I think we've got all of our, let's go to all in here, and I'm going to just make sure. I'm going to say Control A, select all those, right click and say open charts. I'm going to make sure we got all of our open charts for the ones that we have markets on, have orders on, and then we're going to go through all the orders. I think we got some in here that don't have orders on. We'll look at them while we've got it open. So we got some comments in there. What does number 1023 2 to the right side mean? What does the 1023? Oh, I think I explained that, because those were your scales. And so that's why it's not on a fixed scale. That scale will change. On the RSI, it's always going to be 0 to 100. But the right side that's the highest point of the visible indicator. So if you slide back in time, that scale is going to change. It's going to be different. All right, remember that. So we're going to take momentum. I'm going to take momentum off of here for now, just to not confuse everybody, because we're just looking at the two indicators. I will save that as my indicator and apply to all charts. So save and apply settings to all charts. Okay, all of our charts are just going to look like this now. And Tesla, let's not start there. Okay, so we're coming over here. Let's see, anybody else? You are already, I'm going to, are you, of course, you already know what I'm going to ask. What am I going to add? How is this going to go with Bitcoin? And where is the bottom of Bitcoin? Good stuff today, teaching about the indicators land. I give you like, good. I'm enjoying it. Just checking the notes here. I'm seeing the video under videos to watch later. Elaine's Danky McDanky. That's a good name for it. I'm going to steal that from you, C-Boss. We're going to call this Danky McDanky. Okay, so now we're going to come in and look at Apple. So Apple's making a nice ABC pattern in here. Beautiful ABC pattern. Now it's going a little bit more aggressive this second run than the first run, isn't it? So notice that on this ABC pattern, this market went up at this rate. And if we take that arrow, which is what the ABC tool does, and measures the next rate, that market is way stronger than this one, which means you have to be careful. Not that I'm trying to show you another tool, but we do have the, not the Elliott wave. Where's it at? GAN fan. And the GAN fan tells us when a market gets going too fast. And anytime it goes above the 1/2, it's way too fast. It's got to drop down. That's why it dropped down here, came down here, and now it's staying inside that 1/2. It's still pretty high, still up there, still coming up pretty fast. But Apple had some good news. Of course, they got rid of the old CEO. He's not out yet, but he's almost time to walk away. So everybody's excited about the new CEO, going to change things up, and they're actually starting to do something with AI. They've announced that they're going to actually have some AI stuff in their little Apple iPhones. All right, so that's one of the things that we can look forward to, and that's why their stock has taken off. Now, I put this up here because, well, we put it right here when we got up to this peak, thinking that it would fall back down, but this is just a sold call. We're going to collect the premium on it, and then this is our insurance policy in case it keeps going up, which it does. So the whole way to this thing's going to make money is if it stays below that, hits the purple line under the red line. So that's the carnival game. We're playing with these two right here. As long as it hits the purple line underneath the red line. Now, it can go above it, but as long as it falls back down and touches it under the red line, we'll make all of our money. Otherwise, we're going to have to give these guys some money. But our profit is, I capped our losses. So the max loss is between the red line and the green line. So that's where our loss could be. $2,000 could be our max loss. And that's if it hits the purple line above the green line. So if it hits the purple line above the green line, we would lose $2,000. But that would be the max we could lose. All right. So that would be our max loss. Anything above here, and that would be $2,000. But if it comes up here and then it turns around and it flushes back down, as long as if it hits in here, we could lose something less than 2,000. But if it hits here, we get 100% of all of our profits. As long as it hits the purple line before underneath the red line, we get all of our money. And how much would that be? Not very much, because it's 350 minus 115, so $240 or something, right? So that's what we're doing with Apple, and Apple's had some good money, but some good news. So they take off like a rocket ship. Now we bought some shares in here too. Remember, we bought 25 shares right here. Now we should have bought some more. Of course, I was on vacation and wasn't paying attention, but we should have bought some more right there. We got the first green candle to make a new high on a little ABC pattern. Now that's a little internal ABC. It's not one of the big major ones, but it's on its way up. So we could have bought some more shares right in there. Now we can come in here and see if there's any other greens by turning off. Let's turn off the Heiken-Ashies. Oh, see, there was maybe some little opportunities. Not really. That's a red bar, but it didn't drop down. It still had a higher low. I wouldn't have bought any more right in there. I don't know. Maybe right in here we could have bought some more, but I don't know. It's up there pretty high. RSI, MACD has a divergence, right? RSI is dropping back down into the region. We probably wouldn't have bought any there. We'd have been a little scared for that thing to go up one more, especially after that big run. And if we're going to measure it, what's the measurement against that thing? Let's go up there and see where that thing popped down. Right now, it's sitting at 90%. See, and markets don't oftentimes go to 100. They go to 90, and then they like to flush out at 90. So it's sitting there at 90 right now, trying to break up into that 100% level. And I think that's why we put that up there, because we were like, well, we can be pretty confident buying some shares here, because we put that Fibonacci ruler and we said that thing would have to go. And that's why we put those up there, was because we were like, well, that thing would have to go all the way up to almost 130.9 to have that same, but it really kind of took off right here. All right, that brings me to one more thing that we like to play with, right? And we might as well do it while we're here. Let's go over and look at and I know, don't get mad at me. I keep promising you that I'm going to give you guys this. I got to go in as the admin. I don't know if I got admin over here. Yeah, I do. Okay, fair market value. And we're going to look at Apple. Apple's fair market value, we've looked at it before. It's a D. It's not a very well-run company. Let's just put it that way, right? Not a very well-run company. So Tim Cook has been living off his laurels for a very long time. He's been buying back his shares to prop up his earnings per share, and his sales have been flat. For 1, 2, 3, 4, 5 years, he's not really grown that company. So Apple, as much as we love their little iPhones, they're not a very good company. $57 is all their shares are worth, and they're trading for $332. That's an overvaluation of 488%. So if you are an Apple lover and you think Apple can do no wrong, you're part of the problem. You keep buying into Apple, driving that thing up there when it's not worth it. All right. So it ain't worth what they're selling it for. They're selling it for $339 and it's worth $57. Do you want to buy something that's worth $57 and buy it for $339? Well, the only reason you do that is because you think there's a nincompoop out there willing to pay you more than $339. If you buy it for $339, you can sell it for $340, make $1 a share. And that's why you would do it. But it's only worth $57. Just keep that in mind. You're trading something, you're buying and selling something that's trading for $339 that's only worth $57. That's why they get a D. Not a very well-run company, but they're living off their laurels because everybody loves their little iPhones. And so they think that those little iPhones are something special because they've drank the Kool-Aid. All right, let's go back. I've never been a real fan of Apple, and probably to my detriment because they do go straight up. There's almost a religious fervor about their products. So let's go to Amazon. Amazon, now this is a more true company. I don't think people look at Amazon the way they do Apple. I think they look at Amazon as just a big company and they like it. Yeah, everybody buys everything from Amazon because there's anything you want is at Amazon and they'll ship it to you and bring it right to your door, oftentimes the very next day. And if you're, prime prepay your shipping, they'll bring it to you for free. All right. So, but people they don't love it. They don't fall in love with Amazon like they fall in love with Apple. Amazon doesn't, I mean, they have their Fire, what do they call it? A little Fire application, a little Fire thing they tried to come out with, and nobody really bought it. This is an iPad, and I love my iPad. I'm not saying anything bad about Apple products. We all love their Apple little iPads and iPhones and stuff. They're all really neat. But it's just not a very well-run company. Let's put it like that. So Amazon, now, if we're going to look at this in the eyes of the MACD and the RSI, you can see that we came in, look at the MACD, how it started down here. And this is where the trigger line, the green trigger line, let's remove RSI for now. On the MACD, if you had to only choose one, if somebody came to me and said, Lan, you only get one indicator at the bottom of the chart. You don't get RSI, you don't get MACD, there's 10,000 of them in here. All these indicators. And this is just the short list. You can get, there's thousands and thousands of indicators that you can put down here, but they're basically all the same thing. And when it comes down to it, it's like going to the Mexican restaurant, and they pull out a menu that you flip for like 45 days. It's like this thick of pages that you can turn of all the Mexican food you can get. And then what you do is you get overwhelmed. So what do you order? You order a taco. I have a burrito or a taco, and that's what you get because you're so overwhelmed by indicators, or you're so overwhelmed by tacos that and that's what happens. And that's why some of these indicators just become the most popular, because they're the best. And it's just everybody uses them because they don't want to, they just want to eat the taco. They don't want to eat, all that other stuff that you can get in the menu. So the MACD becomes the default because it's really the best one. It really is. And so everything is a derivative of these other really great indicators. So you can see down here how the market kind of reflects in the indicator, and you just need to look at it a lot. All right. You just need to follow it. Just put it on every single chart and have it down there. So I would say if I was told that I could only have one indicator, what would it be? It would be MACD. MACD would be the one indicator I would choose if I could only use one. Doesn't mean I don't love the RSI. I certainly do. Doesn't mean I don't love stochastics. I certainly do. But stochastics, RSI, they're basically two birds of the same feather, right? And MACD is the one that kind of does a little bit better than the other two to some degree. They all have a little bit of a variance because the way indicators are created is it's like, well, this one didn't give me a trigger signal right at the exact zone that I wanted it to. So I'm going to adjust the math so I get an arrow right here. The problem with that is then you get an arrow here, but then it doesn't give you a good arrow here. So then you adjust it and say, well, I want a good arrow here. So then you make a new math formula that gives you an arrow here, but then it doesn't give you the arrow there. So now you have two indicators, one that gives you an arrow here and one that gives you an arrow there. And that's how millions of indicators have been created, because they're all trying to find that holy grail of indicators. And then they just make thousands and thousands of them, and it just muddies the water, which is fine. We need muddy water because that's what makes a market. We got to have buyers. We can't have everybody buying, because for every buyer, there's got to be a seller. And so we got to have some people selling when everybody else is buying. So that's how it works. All right. So we come in here and you can see the little crossover right in here, and you can see how it's building down from here for this. And we'd call this an accumulation zone, right? Because we use the Wyckoff accumulation distribution model. And so when we see a market going through a zone like this, we call that the accumulation stage. Now you could look down here at the MACD and you can say, hey, we're going to anticipate that this is going to break out the top, because it's going to cross over above. It looks like to me, it's a bullish accumulation getting ready to cross over. Once it crosses over the mid zone, well, that's where we're going to anticipate that we're going to get the breakout. Now, which comes first, right? The breakout of the price or the indicator moving? Obviously, it's the breakout of price, because the indicator is a lagging indicator. It's 12 and 26, meaning that it's 12 and 26 price bars or time frames behind the market. So it's not going to break out first. It's going to break out second. The market's going to break out. Then the indicator is going to show you that the market broke out. And you're going to say, well, what good's that? It already broke out. It didn't tell me didn't tell me when it was going to break out. Well, that's because it's an indicator based on past performance. Past performance is not necessarily indicative of future results, but it's the best we've got. So you have to kind of read it as a tool, as an overall trend directional tool. You can't just say, well, when's it going to break out? And that's when I'll get in, because you're going to miss the breakout. So you have to kind of anticipate, because you realize that these indicators are all slow. They're based on past performance, all right? What we call lagging indicators. So anything that uses moving averages is going to be a lagging indicator. I don't care what they call it. There are a lot of guys out there, they'll say, this is not a lagging indicator. This is a leading indicator. And see, because we use this moving average. So it's like, this is the truth, but it's a lie at the same time, okay? So anybody who tells you it's a leading indicator and they're using a moving average, they're blowing smoke up your skirt. Because anything that's a moving average is a lagging indicator. And I don't care whether they call it a leading indicator or not. They're lying to you. It's not a leading indicator if it uses moving averages. So that's why we'll use tools like trend lines or recurring price patterns, or color codes of the market itself, price itself. Anything that's price itself, price oriented. So like the Fibonacci rulers, Fibonacci tools. Fibonacci is a leading indicator. Tools like that actually predict the future without using moving averages or some sort of a mathematical model based on past performance. Now, even the Fibonacci ruler is making projections, right? But it's a leading indicator because it's going off of past performance, but it's not a lagging past performance. So it's not really that same type of a deal. So think of leading indicators and lagging indicators. Lagging indicators are always going to be some sort of a mathematical model that's using past performance to have a crossover of some sort of indicator or mathematical model. That's a lagging indicator. So the market's going to break out, and then the indicator will indicate later that it's going to break out. But if you can read the indicator, the past performance, and if the indicator is looking like, hey, I can anticipate, and that's the big word in trading. I anticipate that the market is going to break above that zero center line. And when it does, it's going to take off like a rocket ship. So you're going to start accumulating your shares in this zone in here in anticipation that market's going to cross over, and that's where everybody else is going to jump on, and it's going to take off and go like a rocket ship. All right. So that is how you trade. You have to anticipate the future based on past performance and what it's doing and where you think it's going to cross and take off, so you don't miss the takeoff, because the indicator is not going to tell you the takeoff. And always remember that. It's not going to tell you the takeoff. It's going to tell you after the takeoff happened. It'll give you the little arrow, the little buy arrow, the little sell arrow after it already happened. In fact, MACD has arrows. You can come in here and turn them on. Let's see. I think we can turn them on right here, displayed. All right. So, and then that's where the just as land comes in and says it's going to tell you after. It really did come in and kind of tell us right before. But there's a good example right there. After, right there, after, right there, after. This one here. It's a little bit. This is a little bit early in here, but that was a good one, wasn't it? Went from yellow to red right here. Boy, that thing came in right at the right time. But most of them, you can see it's where the market has already dropped. The market's already dropped. The market's already risen. The market's already dropped. It's already gone around the corner. So there, right here, see this? It took off on 1, 2, 3, 4 bars before it figured out that the market was going up. So just always keep in mind that what you want to do is you want to be anticipating where you're going to get that little blue arrow from the indicator, and those are going to be your buy-sell zones. Okay? Makes sense, doesn't it? All right, that's Amazon. So let's go look at Amazon just for fun. We're going to go over here and see if Amazon's any better than Apple. AMZN. Are they a better run company? They're a little bit. Look, they're a C. They're not a D. Okay, so they are worth $129 a share. Now, that doesn't mean the company's worth more. It just means that based on the number of shares they have, this is the value of the shares. Okay, and it's trading for $235. That's not bad. That's only 78%. 78% overvalued, but it does give them a little strike. So, but you can see Amazon straight up, like, man, you wish Apple looked like that, but they don't. And the thing that Apple does is they're buying their shares back. That's bad. Anytime this goes down, it's good if you own the shares, because somebody's got to buy the shares to push the stock up. Unfortunately, it's the company itself that's buying their own shares to push the stock up. Everyone tries to tell you that that's good. Oh, they're buying their shares back. That's so good. They got so much cash. They're buying their own shares. Stop buying your damn shares. and go out and spend that cash to grow your business, make more money. Don't give it back to the shareholders. All you're doing is propping up your stock till your earnings per share go bigger. And that's why we nail them to the wall when they do that. Don't do that. It's bad. Don't buy your shares back. Stop buying your own damn shares back. Okay? Grow your company instead. Grow your company with that money. Don't go buying your shares back and propping your stock up so that people won't jump out and realize that you're a poorly managed company. That's what that means to me. All right. So this is the BS detector. And you can see that they have very little BS. If you went back and looked at Apple, they have a lot of BS. Okay. So this is a little bit better run company. Not great. They still have some problems. They have aggressive dilution, earnings backed by cash. See, that's good. Margin holdings overvalued by 79%. They have a little BS going on in there, they say, but not too bad. This is the biggest problem, is that they're overvalued. They're worth $129 and they're selling for $231. All right. And they don't have the religious fervor around Amazon that Apple has. Okay, let's go on to our next one. Better hurry, Lan. At this rate, you're going to be here all day. All right, here's APPO. Do we have any money in here? We got these positions. Oh, these are doing good. See, because the market's falling. Well, we're making money in Apple too because we got the shares going up. Let's go see on a chart. What is our shares are up 1,500. See, we're only down $18 on our little spread, so we're not hurting too much on that. It's only $18. If it gets a little closer, we might take it off. I'm waiting for that to flush down just a little bit. If it keeps going up, we'll take it off. But we're making good money on the long positions. At some point, we're going to want to take those shares off. Where are we going to take them off? Look, well, the MACD's starting to get a little toppy up in there. We might want to take some of our profits off of these shares. Maybe what we can do is we'll put a stop order in here. Do we want to do all 25 off? Let's just come in here. We'll be real aggressive and say if it breaks, as soon as it breaks a low, we'll just put it right underneath the current price bar. If it breaks that current price bar, we'll just take our profits and get out. How's that? So if it goes bump, we'll take it out. It might bump and turn around and go back up. We can always get back in, but we'll just take our profits. We'll bank them right now. All right, on that one. So we'll put a stop order on there. It's good till canceled. That's a good way to trade that one. We'll come in here with Amazon. Amazon, the only thing we've got is this little spread up here, and it's making us $160. And the chances of that thing being up here by that purple line is, we could go look at the odds of that. It's in the options table, but there's no reason. It's going to be like 90% chance that we're going to get that paid off. So that's a no big deal. All right, let's go to the next one. APPLY. Now we got in right here. Now look at the MACD. We were a little aggressive on that one, weren't we? I was kind of, the problem is when we trade, sometimes we buy into markets just because we're having class. Not always the best time to be getting into markets because we're having class. But we can see that would have been a nice, had we been paying better attention, we could have bought some there, which is what we did, and we plan on buying some more down here. So we get a little ABC pattern. We buy some on the first, just in case. We do a little accumulation, in case it does take off and go without us. But you can see down here, the MACD was coming down, and everything was red. If we were paying better attention to the MACD, we would have been smarter and wiser just to hold on down here and not have this. But it did come down. We could have had an opportunity to buy again there and do accumulation. But now the market's starting to rally. It's going back up. We got our first green candle to make a new high right in here. The problem is we're at a point of resistance across the top right here. So I'm not real thrilled about adding on right now. That would drag our dollar cost average up and we'd start building an upside down pyramid. So we don't want to do that. Let's wait for a dip. We might break here and come up. Maybe we'll get a dip back down and test that again, and then we can put a little bit more in. Problem is I don't sit here and watch this unless we're in class. So we might miss some of these things, and that's the problem. Are we going to put a stop order in there? We could. You could come in here and say, look, I'm going to put a stop order. I don't want to take a loss on a winning trade. I want to turn a winner into a loser. So we could come in here and we could just, how many have we got? How many shares? How many shares is that? 415. Holy cow, that's a $12 stock. So let's go 415 and $5,000. So we're going to come in here and we're going to put our 415 stop. We'll just put it right at break even. So that way, if it does turn, just right above just underneath that red dot. We'll just get out of break even. Just let it go. We could take some profits off. How much have we got? We got $300 in profit. We're up 6%. I think we can let it go a little bit more. Let's see if it's not going to break above that previous high and continue to rally in that green. We could put a little Fibonacci projection on there. Leading indicator. Says we got it up to 61.8, 90, 100. We could put a couple little orders in here. We could come in here and now in the stock market, we can't have, well, we can if we do it like this. Let's do it like this. Let's get rid of this one. Come in here, and we're going to add an OCO. And we're going to put this for 415 right here. And we're going to say if it comes up to 90%, just inside about 90%, we'll take our profits off there. How's that? We can trade it like that if we want to. And then we come into Blackstone. Same thing. We're making a little bit of money on Blackstone. Did you want to go see APLY? It's a little tiny stock. I don't know. Well, we can go look. I don't think it might not be there. APLY. APLY. You guys might like this stock. See, it's too small to be in there. So, but it might be a good stock for smaller portfolios because the share's only $12 and easier to trade. All right, Blackstone Group. Now we're making a little money on this one. It's starting to go. If we want to protect ourselves so we don't take a loss, how many have we got? 17. So we're going to come in here. We'll run that down to 17, and we'll put a stop in there. We'll just put it at break even, just underneath right here. Just in case the market turns and flushes real hard, we'll just get out and not lose anything. You could take some profits here, but we're only up $175, so we'll just let it go. See if it doesn't want to move a little bit more. We got CRM, Salesforce. Now, that's the one we were looking at. That's starting to take on. Now, there's our MACD. Look at that. We timed that one pretty well with the MACD. It had its first run, came back down, and had we put a stop in there right there, we'd have got stopped out. Keep that in mind. Everybody knows what the MACD is. A lot of people trade the MACD, and so that happens. It's pretty common to see the market. You get in where the MACD crossed, and they know that your order's there. The market will rally. See right here, it came down and stopped everybody out. It went up and did it again, come down, stopped the rest of everybody out, and then took off. That's because everybody put their orders here because we all watch the MACD. We all get in at the same time. So there's a whole pile of orders sitting there. The market rallies. Everybody puts in their stop at break even. And then the market comes down, stops you out only to take off again. So there's two strategies there. Is one, don't get in here. Wait for it to go up and come back down and then get in. Or wait till it goes up, come back down, and then where it's stopping everybody out, get in there. But generally, you don't do that. You wait till the first green candle to make a new high. So you'll get in here, and then it'll do the same thing. It'll go up and come down and stop everybody out again. That's why markets go up and down, up and down, up and down. Because they're going up, and then they come down, stop everybody out. They go up, come down, stop everybody out. Go up, come down, stop everybody out. All right, so you just have to play that game. That's the game. That's the name of the game. You have to play again. Look at this, all through here. Goes up, comes down, stops everybody out. Goes up, comes down, stops everybody out. Goes up, comes down, stops everybody out. Each time you get a first green candle to break a new high, that's a buy signal for a lot of people, right? So a lot of people get in on the first green candle to make a new high. So if there's not enough strength to carry that thing through, there's no fundamental reason why the market would rise. It'll rise a little bit, get everybody's stops in there, and then come down and stop them out. There's no reason that that's a trend. There's no news event, no fundamental reason for a market to rise. Well, it'll just sit there and go up, get a green candles, couple of green candles, 3 or 4 green candles, come down, stop you out. So that's just the way the market's designed. That's how it works with these big market makers on the other side of the trend. They're just playing the retail traders. They know that they can take your money like that. So that's why markets do that kind of a trend right there. This is Carvana. Carvana is that car company where you can go in like a vending machine. Have you ever driven down the freeway? Here in Utah, we have one. Is it right there in Ogden? So in Ogden, North Ogden, up by Hill Air Force Base, there's a big vending machine of cars. It's kind of a round building. You order your car on the phone, and then they put it in that little vending machine. And you go down to the vending machine and put in your code, and the car comes down. You don't even talk to anybody. It's just a vending machine for cars, and you pay for it on your phone. So it's called Carvana, CVNA. Oh, they're not in here either. They are. Got to be in here. CVNA. Come on. Are we really not going to have Carvana in here? No, Carvana. Oh, that's Canvas is already in use. Chat with ID must be, what the heck is this? CVNA. Carvana. There it is. They're an F. Look at that. They're worth $7.53. They're trading for $64 a share. They're overvalued by 762%. This is their last year chart. Last year in July, they were at this price. Way up, way down, way up. Now they're just sitting here at the exact same price. They didn't move all year long. They're making money and anticipating. Look, this is $22 billion they're making. People buying cars from a vending machine. They're buying their shares back. Look, they released a bunch of shares to raise some money, and then they bought them right back. And then they released a bunch to raise a bunch of money, and they bought them right back. So they're anticipated to be at 0.74 billion shares. But look at this. This is a tremendous amount of manipulation right here. Shareholder dilution. So we come in here and look at some of these things in here. So this is, they're going to, years to price, and they're going to never catch up. They can't catch up to that price. That price has to come down or they have to go up. $7.53, overvalued by 762. At the rate they're growing and doing this kind of stuff, says they'll never catch up to their evaluation. So that just means that stock has to come down. Earnings per share growth is backed by real earnings. Buybacks accounts for up to 5% of it. Options desk, maybe trade options on it. The IV rank is a little bit, options are expensive versus their 52-week range. Selling is a good premium, so we go sell some options on them. People are scared. That's why you sell options, because people are scared and need some insurance. So you sell them some premium, collect the premium. So that's an F company, though. All right, so let's go to Google. Now, Carvana, we don't have a trade on in there. We could probably just delete that from our portfolio. All right, Google. We did the same thing in here. We sold ourselves a little insurance premium up there, and we're collecting on that one. We'll collect that one. That'll pay off. The chance of that thing being above the red line by the purple line is slim to none, and slim left town. So we'll get that full premium right there. In fact, we probably have most of it already. I have 86%. You could hang on to it to get that last little $25. There's no reason. You could just take that off right now if you want to, but there's also the chance of it getting way up there. But you've got a bunch of money sitting there on the sideline being held up. So usually when we get to, usually when it's 50%, we'll take it off. We're sitting at 80% right now. We can just take that off. We just liquidate it. Come in here. We'll just mark it out of it. Take our profits. That way it releases some money. We could go put it somewhere else. We could put these on again. We kind of wait. It's kind of neutral right now. If we put on our Fibonacci ruler, let's see if there's not a better opportunity somewhere. Come on. There we go. So you can see right now that's sitting dead center of the neutral zone. So let's wait until it gets into an extreme, and then we'll take advantage of the fact that it's in an extreme, and then we could put some more money on that one. We'll just wait for Google to come back, give us an opportunity. All right, HIMS. This is in here. We don't have a position on HIMS, but my son said he was trading this and he caught this whole run and he made a bunch of money on it. So he wanted me to look at it with him. And so I don't know if he's still in it or not, but my younger son, Arthur, not Ben. Some of you guys know Ben. You met Ben in St. George at the university. He's teaching down there with me, and you guys met him. But this is a nice little 3-drive pattern. Look at that. Drive 1, counter trend, drive 2, counter trend, drive 3. Stick a fork in it, it's done. All right. So we'll see. There's an opportunity in here for options. Now this will probably bounce right in here, come back up, but I think we'll get another little bounce down. That would be an X1SA1, and I don't trust X1SA1s. So if we wanted to put an option up there to sell some premium, we could probably go and take the time to do that. Let's go see if there's anything. 24 days. Volume open interest. Oh, it's probably possible. You might be able to find something up there. We could sell this one. Oh, that's too close. Probably not where we want to go. We want to be way up here. We want to be at a delta 20, like there. How much is it? It's only worth 79 bucks, and then we have to buy one. No, yeah, we have to buy one. So we buy one, it's worth 59. The only thing you're going to make is $21. It's not worth it. Bye. See ya. Don't want to be ya. All right, into it. Into it. Are you into it? I'm into it. All right, let's go look at into it. So, into it. INTU. INTU. Oh, C company. Now they've been struggling. They're way down. So buy low, sell high. So look at this company. They're making money. Man, look at them. They're making money every month, every year. They're higher, higher, higher. That's what you want to see. That's beautiful. Earnings per share going up. They're not buying back their shares. I think there's no BS. That's a very little BS. That's their cash flow. Very good cash flow. Years to price. That's the worst thing they got. Aggressive dilution, it says. What? Severely overvalued is the worst thing. They're overvalued by 653%. They're worth $41. They're trading for $315. The Graham numbers say they're worth 146. Fair Lynch says they're worth 218. But because of the aggressive dilution, but it doesn't look like aggressive dilution. I'm going to check that. I'm going to write that one down and have old Claude go take a look at that one for us. That's into it. And find out how come it's getting a D. How come it's getting a C and we're getting aggressive dilution? I'm going to do a little research into that one. I want to find out what's going on there. All right. Company profile. When you're in this program, make sure you click these little chevrons, these little drop-down windows, because they're all over the place and they give you more information. All right, so let's get back to our portfolio. You got to go a little faster, man. Look, we had a little opportunity to buy right here. There's a little red bar right there. First green candle to make a new high. We could put a little more in there. The problem is we missed the couple of days. We could put, let's put this 19. Let's put a couple more shares in there. Let's put 2,500. And then if that drops back down, it'll give us an opportunity to buy some more. But if it just keeps going, just keeps trucking back up, then we'll have our shares. But that's going to bring our dollar cost average up. So we got to be careful. We don't want to build ourselves an upside down pyramid. We want to buy the dips, not the rallies. And we just bought the rally. But that's because we're here in class. So keep that in mind. You guys do it right, not like we do it in class sometimes. So there's a nice little spot. Look, we got in there. Oh, there's the second green candle break a new high on Microsoft, I think. And we got this sold. What is that? Sold call. That's a sold call sitting there naked. We got a naked call up there. We got a naked what? Land. Why do you have a naked call up there? Or is that a cover on this? What are we doing? We bought the call and we sold the call. Oh, so we're covered. We sold the call up here for this one up here. Sell a call. So this is a poor man's covered call, isn't it? So we sold this against this. So we're good. We're okay. If that goes up there, and it looks like it's going to hit the purple line above the red line, we're going to have to roll this one. We're going to have to roll it out and up and out. I hate to roll, but I don't want to lose my poor man's deep bought put call option. See that call option, that's up $359. Oh, that's the shares. Our long call, see, it's got 416 days to go. So that's like, and then we bought it deep in the money. So it's up $157 and we're selling that option against it. What did we collect? We collected $500 and we're down $80 on it right now, but I'm not worried about that. We'll get that $500 if it comes in and touches a purple line underneath the red line. If it doesn't, we're going to have to roll it. So we'll keep an eye on that because this is a poor man's covered call. All right, we could buy some more though. Let's come in here, trade 14. How much money do we have? Oh, we got lots of money. Oh, no, we don't. Cash available, 60 grand. We got lots of money. How much do we want to put? A 14 would make us double it. That would take us, if we do 14, that would put our average now. It'd be below this one, so it's right here trading right now. That would put us right about the red line, right underneath. I don't quite want to do that. Let's come in here and let's move that entry point up to maybe where we could say, because if it comes down and stops us out, we don't want to get stopped out. Let's come in here and let's do, let's go in 2 or 3. This is what I like to do. I like to go in, let's go in like 5 at a time. So we'll buy 5. Oh, the 5 was a little bit too much. Jumped our order up a little bit too much. That's all right. We'll go with that for now. Where are you going to put your stop, Lynn? Well, I don't want to put my stop. We're in with 19 shares in Microsoft here. I don't want to put my stop right here at break even now because I just jumped that thing forward. And there's a real likelihood that they go up, get 3 bars, come down and bam, stop everybody out who just did that same thing, right? So we got to still risk a little bit. We got to risk it to make it. So we're going to risk it back down in here. If you want to risk a whole bottom, I don't know if we want to risk that far. But we'll risk a little bit maybe back below that green bar. We'll hold this we'll just watch this for right now. If we get nervous, we can move that around. But for now, we'll just put our stop back here to protect those 19. But I don't want it up there above because real common to that get a spiky dikey do to come down and stop everybody out, only to turn around and take off and go again. So keep that in mind. I don't want a spiky dikey do, but I want to protect against it. All right, so here's Misty, MSTY. That's an options income strategy. We got a little bit of Misty in here going. Market's going sideways. This is your Bitcoin. This is your Bitcoin, C-Boss. So let's buy another 14 shares. Let's come in here. We got 14 now. Oh, 114. 114. Why did we do 114? Because 114 was $15,000. So we can put 15,000, another 15,000. Now remember, we're getting dividends on these. Every week we're getting a big chunk of dividends coming in. Now remember, if you're doing this in an account that is not protected through an IRA, you got to pay taxes on every single penny you get out of here. Well, not every penny. $3,000 gets to be written off against them, but that's it. Anything over $3,000, you're paying full taxes on that thing. Okay, so we're going to go in here. We'll buy another. So we got 231. I don't know if we needed to do that. That was kind of a crazy move. We're getting serious here. Look, that moving averages are all coming together. This is saying that we think that Bitcoin's going to go up from here. But look at the MACD. All right, look at the MACD. Now I'm going to do something. Watch this. Watch this neat little trick. Okay, I'm going to make the MACD bigger by moving it back in time. Ooh, look. See, now you can see it a little better. Look at the MACD. We just crossed over right there. It's still coming up. We added a little bit more in here. We're going to anticipate. We're going to anticipate that thing's going to go up and around before it goes back down again. Go up and over the top. So that if to happen, that would go up, right? And then back down like that. So let's see if it does it. Now, the reason we own this MSTY is not because we're expecting growth. We're not. It would be nice to have some growth, but we're not expecting growth. We just don't want it to go down. Sideways is perfectly fine because you're getting your dividends. And now remember, on this market, these are not real dividends. They're not shares of the profits of the company because, well, Misty, this is they're selling covered calls and they're collecting premium. Now, you could do that yourself, right? Remember, covered call. That's what we did back here on Microsoft. We've got a poor man's covered call. So they're doing covered calls just like this. They're collecting that premium. See that $500? Well, they share that with you. So if you put your money in there, they're going to go do a whole bunch of covered calls on Misty, and then the covered calls up there, and when it expires, they give that money to you. So that's how that works. They call it dividends. It's not a dividend. It's the distribution of a covered call. So don't put those on unless you really think the market's going to start to rise or stay sideways or rise. If it's going down, you'll still get your covered call money, but you'll probably, well, sometimes you'll lose as much in the market falling as you make in your covered call. Sometimes a covered call makes way more money than the market falling. So even though the market's going down, you're still making money. But a flush like that's going to actually probably lose way more money than what you're going to collect in a covered call, especially at this rate. I mean, this thing is now only trading at $12. So the premium, well, this is not the options premium. The one they're trading on is MSTR. So this is actually the stock they're trading the covered calls on right here, and it's $110. So the options you can see in here. If we go out and do a 24-day option, see they're $800. That's not the money. They're not doing it at the money. They're probably doing up in here somewhere. So they're collecting $662 in the next 24 days, and then they give that to you, right? That's the covered call. So you sell one right here, just like that. But you got to own it. Well, we got to bring it up here a little ways. So there's $260, $185 they're collecting right there. But that's 15% annualized return, or 15%, 150% annualized return on that covered call. That's a lot of money. But you're going to get your money. But they'll roll it if it goes up there. So it's got to close below the red line to get the money. That's what they're doing. They're just trading covered calls for you. So you give them your money, they'll trade covered calls and give you the money. You can trade covered calls yourself. Then it's a different tax situation. All right, so we talked about that. I'll go into that in greater detail. This is a short position we took on Micron. Look at that. We shorted it with one order right there. I don't know why we did that, but we did. Right at the very peak, we picked that one right and nailed it. That must have been class one day. We took one short. That's funny. It's up $370 on one short. Oh, well, that's because it was $1,000. And what were we looking at? We were probably looking at drive 1, counter trend, drive 2, counter trend, drive 3, counter trend. It made that little spiky dikey do, and we said, let's take that baby to the short side. And we did. So now here it's coming down. We're going to make the Fibonacci ruler. That thing's going to come right back down. Look at that. It's touching the 50% like a train on rails right now. And it's done it once here, done it once here. We'll see. The floor, remember, is 61.8. So if it comes down to 61.8, that's where we can be a buyer. Doesn't mean we can't be a buyer here. We certainly can. And I did. I bought some right there in my real money account. I bought some right there. So if it keeps coming down, actually, I think I bought it here. I bought it right here. So then it went up, and now it's drawn back down to my entry. But I don't have a stop because I'm looking for it to come down to 61.8 where I can buy some more. So we're going to put this in here. And of course, I'm doing this in Chippy, which is, MU is in part of Chippy. So I'm collecting dividends on it. So that's a nice dividend paying Chippy is. So I would buy some more right here at 61.8. We could put a little bit more in there right now. We got one short. We could take our profits right here and then start buying. Let's do that. Let's come in here and we will exit this chart. So we take our profits and we're going to put a little bit of stop in here. Let's go small because this is such a big market. $690. That's $800. Let's just do that's $16,000. Let's just do one right now. Let's just buy one at the market. And then we're going to put another one in a limit in. Let's put another limit in down here just inside 61.8. Now, I don't know when that's going to fill. It's good till canceled. We'll see if it fills. You guys are going to have to help me remember that we did that because we'll come in and if it's filled, we'll just say, oh, we got too long and we won't remember that we did it like this. All right, Nike. Nike, we put a little bit in here. It's been going through this accumulation stage. Look at the MACD. It's going up. Are we going to anticipate a breakup of the MACD right in here? First green candle. Let's add a little bit more in. It's only at $43 and we've got, it doesn't look like it wants to go down anymore. This has done its down thing. Let's go look at Nike. NKE. Nike. Oh, come on. I know you've got Nike in here. Am I doing the SIM ticker wrong? No, it's NKE. I know what I'm doing. NKE. There it is. SFO True Value can't compute Nike. Its real earnings power is negative or undefined for the latest fiscal year. This is expected for a loss-making companies. There are no real earnings to capitalize yet. Industrial or valued or owned earnings. Financials excess return our book value, and the book needs positive earnings for tickers with incomplete FMP statement data. We'd rather show nothing than made-up numbers. Okay, we're going to show nothing on that one. That doesn't make sense. I thought we saw that one before. Really? Nike isn't in there? Okay, we're going to buy some Nike. We're going to come in here. 45. 45 is what we had before. 30, 45. So that's 20,000. Oh no, that's only 1,900. So that was $2,000. That's what we were doing. So 47 would be $2,000. We got $55,000. Let's go ahead and buy that. All right. So we're just looking for Nike. Now we might want to put a stop in here. But I'm more in the accumulation stage on Nike. I don't know. We could come in and say 92. If you want to stop us out, we could put that down here in case it just breaks down. Problem with that, it come down, spike down, hit you, and then turn around and go back up. If we're going to get out, we should get out before that. You should just put it right underneath the bar and say, if you get, but I don't want to do that. I want to kind of do an accumulation here. I'm just not worried about Nike going down a little bit more. We could protect ourselves with an option. If I was really worried, but we're only at, we're at 92. Let's go ahead and do that. Let's go in here, 92, 93, 94, 95, 96, 97. How many do we need? 8, 7, 8. So we're going to buy 8 more. So now we have 100. So now we can come in here and we'll go in and we'll just buy a little shorty. Let's just buy it. When are we going to meet again? In a couple of days. Let's go look at 10 days. While we're buying it, maybe we'll do 24 days. We can always liquidate earlier if we want to. 24 days. And we're going to come in here and we're going to get a put option. And we're going to protect ourselves to the downside with a soft stop. This is what I call a soft stop. It's $159. So we're going to go back here, 112. Let's see where this is at. Let's buy that. And we could bring it down. Let's put it like right where we'd put our normal stop. Well, let's put it right there. It's going to cost us $61 to have just a little insurance policy for the next 24 days, just to see if that thing goes, right? But if it turns and flushes, we'll be protected at least for the next 24 days. But it's only $61. We could go out a little farther, give us a little more. Let's go out. Let's double that, 52 days. How much would a little insurance policy cost us there? Just to give us a little peace of mind. You know what I mean? We can, for $52 premium. Look at that. We could get one for $55. That's less money than that one. Let's kill this one. And let's get this one. It's only $55. Let's buy that put option. Oh, it's farther away. Let's go there. $115. All right, let's go ahead and we're gonna have to mark it into it because they don't let you bid for that anyway. All right, in the demo account. All right, here we go. Go to NVIDIA. Oh no, NVIDIA. Oh no, everybody's getting an opportunity to buy you now. Oh no. Okay, here we go. Fibonacci ruler back right down to 61.8. That's our floor. Okay, bang, bang, buy, buy, buy. That's what you want to do here. And if it comes down to 78.6, buy, buy, buy some more. That's all we do, right? Buy, buy, buy. Okay, so we bounced and now we're a little bit higher than the bounce. So today it came down, touched 61.8, and it's retracing back off of 61.8. So it came down, touched 61.8, and took off like a rocket ship. There's 3 drives. Drive 1, counter trend, drive 2, counter trend, drive 3. We're at the top. I don't think we're going to see much more of a rally. Doesn't mean we can't. Certainly can. This is just a 1-minute chart, but it's starting to pull up here. I wouldn't want to be a buyer. We're on the backside of the MACD. See that? How it's red coming down the backside. Not real thrilled about getting long right in here. We want to wait for it to dip down a little bit more. I think we're going to. It's already made its nice little 3-drive pattern up. I'd like to see it drop a little bit more. It's kind of getting a little run in there right now. I'd like to see it come back down into these regions here before we put some on. Afternoon. What do you guys want to do? What do you want to do? Let's come in here. We might miss it if we don't buy some right now. We could buy 2,000. Let's put $1,000 on. So this is what we do. We don't want to miss it. Let's just put 5 shares on. Okay, so we'll put 5 shares on there. And then we'll put a limit order to buy 5 more shares. A good till canceled. We'll put that right at 61.8. See if it'll pop down there and grab that one more time. Not sure it will. But then we can also, that's just for another 5 shares. And let's put another 5 shares down here at 78.6. So we'll do a little accumulation on the way down, see what happens, all right? And if we got some, so if it does take off from here and go, you know, we got the little MACD's popping its head up above the midpoint, but it's not very strong. It's coming down. So you can see what that looks like, but that's on the Fibonacci scale. You can see that the RSI is dipping, so there's still some opportunity. The RSI is coming down. We want to be a buyer of the when the market is down in the RSI is turning and starting to go back up from down in underneath the 30. So that's where we want to be a buyer. So we got the opportunity maybe down in here to buy some more down in here. Draw this down. Dollar cost average down, not up. So that would get us into NVIDIA. All right, so there's Oracle. Oh my goodness, on Oracle. Oracle makes me so mad. More Oracle downtrend. Look at that, one little green, and that's where we got in before. And then we had to get stopped out. We got stopped out way down here. I was feeling really bad about that one. Man. We got NVDA. NVDA. Can't. Oh, come on. I'm not going to play this game. I know we got this data. Don't sit here and tell me you don't have NVIDIA. NVDA. There's NVDA. So they're a B. That's a good company. All right. Being well run. They're worth 80. Here's the problem. They're worth $85 and they're trading for $197. So they're 131% overvalued. So 6% of earnings per share growth. NVIDIA is worth about 85. It's aggressive. They will grow into it in 8 years. So that's not too bad. We generally figure 5 years. And so this one's outpaced by 8 years, by an extra 3 years. So that's why it's a little aggressive. So NVIDIA is worth about $85 today, but it trades at 197. At its own approximate 10% growth rate, it would take about 8.8 years for the business to grow into today's price. 6% of earnings per share growth since 2007 is manufactured by buybacks, not earnings. Well, that's sad. They're buying that's not too bad though. But look at their earnings going straight up. Look at that, billions of dollars they're making, and they're anticipated to make 253 billion more. That's very little. Well, you know, it's all relative. But that's on the BS detector, not too bad. Severely overvalued. That's their only downfall. And look at this, January, February, March. April's not too good for them. July, we're coming into August. August is a good month for them. September's not so good. October, November, December's not so good. So this is the seasonal nature of the market over the last 10 years. We go 20 years. Woo, changes a little bit. Go to all data. I don't know how far back all data is, however much data we got. There's 5 years. September's rough. August is rough over the last 5 years. So be careful in August. Doesn't look like we're going to have generally speaking, seasonally speaking, we don't have a big run in August. But over the last 10 years, we have done pretty good. But over the last 5 years, August hasn't been that great for them. All right. Okay. And they're almost right back to where they started. Here's where they started at the beginning of the year. And they're up a little bit. They're up a little bit. A little bit. That's 42%. Up $70 a share, up 42%. So that's pretty cool. Okay, let's go back and look at Oracle. Do you want to put a little bit of money? Oh, that was NVIDIA. That was over here. Okay, so let's come back and let's go back over into Oracle. ORCL. There it is. All right. Oh, Oracle's a D. Earnings per share is inflated by buybacks. So they're buying back. Oh, look at that. You guys. Come on. And their cash flow sucks. They're hurting. So they got a big facade here, big BS detector going off. And, but look, they stopped buying their shares back in 2022, 23, 24, 25, 26. So their shares, they've stopped buying them back. So that's good. And their growth is huge. Look at this. Now we don't have on this one, we don't have a trailing 12 months. This is 2026. It's not giving us a projection on that one. Let me write that down. How come we're not getting a projection on Oracle? ORCL. No trailing 12 months projection. Why not? Okay, so they are trading at 120 and they're worth 124. So they're actually fair value. They're less than under 2.8% undervalued. Now, Graham says that they're only worth $43, and Fair Lynch says that they're worth $144. So that's quite a disparaging number. I think ours is more accurate at 124, but they are a D. 5 demerits. Trade options on them. I've traded options on this one. Made some money on these guys with options, I think. I think I got some right now. Maybe I do. Maybe I don't. Can't remember. Trailing 12 months. Did that pop that up? No, that didn't change it. Go 5 years. 5 years. 3 years. No, still a D. Trailing 12 months. Oh, they go to a C. So the only thing they're getting in trouble for is their buybacks. But they've stopped their buybacks. So we'll go 3 years, 5 years. Okay, so that is Oracle. I really want to buy some Oracle. I think what we need to do is we need to wait for it to bounce, pull back, and then as soon as it starts to go back up again, that's what we'd look for, right? That little ABC pattern. But right now, look at this. Look at the MACD down here. It's turning green. Had a red one today, or red one yesterday, but today, red one on Friday, but it was today, Tuesday. So I had a red one yesterday, but it's back to being green today. So that's positive. If you wanted to do an accumulation based on the MACD, you could put some money in right now. It's $120. You could buy one. I don't know. We'll just put it in there for like a little indicator to watch it and see what it does. Okay. Okay. Pro shares. We don't have anything here. Let's skip that. Oh man, that looks too good though. Ultra short Bloom. SCO. Oh, that's our crude oil. Getting ready to rally again. Oh, I'm in this thing long. Oh, that's good to see. It's starting to pop back up. That means crude oil is going down. We should, let's come in here. Buy 100 shares of this. All right. Let's come back to Shopify. Oh, look at that big rally today. Holy cow. Why weren't we day trading that one? Come in here and do 1 minute on that. Whew. Turn on the Heikin-Ashis. Wow, that thing took off. Ooh, look at that. Right out of the gate. Rallied up hard and then flushed right back down like a toilet. Hit that 100-period moving average, just rode along it like a train on rails, then took off again, fell back down. Took off again, fell back down. Took off again, fell back down. Took off again, went sideways. Took off again. That's crazy. What a market. Wow. Looks like it's dying now. It's on the backside of the MACD. We went on the backside of the MACD here. You wouldn't, anytime you're on the backside of the MACD, don't be a buyer. Wait till it flips, mate, till you're in the green. You're in the green, buy, right? So MACD in the green, you can buy. If it's in the red, don't buy. Don't take long positions. Like right there. I know right there, you're looking at that and you're saying, I'm buying that. I'm getting in long. Nope, it's on the backside of the MACD. Look at the MACD. Don't buy that. All right. Wait right here. Now we're in the green. You could buy that one. You could buy those red bars right there. Now we got more red bars, more green bars. Nope, it's on the, I don't know if we want to do that right there. We're getting kind of a nasty little thing here. We're getting convergence, right? Not divergence. We're getting convergence. A high here and a high here. a lower high here, and a lower high here. So that means the downtrend is in effect. That thing is going to turn and flush down some more like that. That's the convergence, not the divergence. We're not getting divergence. Okay, let's come in here. SM energy. Ooh, we weren't watching close on there, were we? That was our trend broke right there. We had long on that one. Well, the problem is, there's several problems with this. One of the problems is coming down and it's trying to hit that 61.8, which could be a bounce. So it could bounce off that and come back up a little bit, even though it'll probably turn and go like this. Because this is lower highs and lower lows. Look at the MACD turning right here. It's getting on the backside. Getting a nice little trend coming off of here. Broke that, went up. Missed our money taking profit opportunity. That's what we get for taking a week off, going on vacation. What do you want to do now? It could bounce here. That's the thing. Could bounce here. Let's just go ahead and play it. You want to play it safe? Play it safe. Let's just take 20 of these off. Let's go ahead and sell the market right now. So we got, well, let's leave ourselves with 20, 18. So 18, 19, we just need 2. So if we just leave 2 in the market, 20 in the market, and then we'll pick up, let's come in here. Let's watch it. We might pick up, let's go look at this thing. This is SM Energy, SM. They're a B company. We'd like to own them. Ooh, look at that. True value is 200 and they're trading at 29. What the heck is wrong with that? Undervalued by 85%? That doesn't make any sense. What the heck is going on? This company is undervalued by that much? Below fair value. What does Graham say it is? Graham says it's 72. Well, even 72 is way overvalued. Revenue is up, margins are down. Earnings per share growth is backed by real earnings. Buybacks account for under 5% of it. Below fair value. They like that. Options trade, maybe. Look, this is where it was at the beginning. It's flushed way down, came back, made all that money back, went up, and now it's coming right back down to where it was at the beginning of the year. But look at their making money. 3.7. Wow, let's go look and see if they're making profits. 648 million. They're making 20% money. That's good. I don't know. I mean, they're a B company. They're a B company. We like to own B companies. All right. But we're toppy up here. We're very toppy up in here. How much is it from the very top? 61.8 right there. Punching 61.8. I think we should put some more money in here. Let's put another 10 in. We took some profit off, so we made some money on them. Let's put another 10 here at 78.6, just inside 78.6. If it comes down and touches 78.6, we'll add another 20, another 10. How's that? But right here, we put in, well, we took some money off right here. We took our profits. We should take our profits a little higher, but this is where we should actually be adding in 61.8, but we took profits off. We'll add in at 78.6. Just let's see what happens. SMCI, super micro. Where are we at on this thing? Down at 78.6. We lost our floor. That's not good. We wanted to stay above 61.8 on those retracements. Came down to 78.6. That's negative. That's a negative. Look at our bulls and bears. I mean, look at our MACD. Since we're trading MACD today, we're looking at MACD. It's gone into accumulation. Look, it's gone green, and then it's gone red. Now it's back to green. Back to green. It's pulling back a little bit. It's making a little head and shoulders formation in here. We got a little action like that. So that means if it pops back down here, as long as it doesn't break this low, we can be buyers at the right shoulder in anticipation of that being a new higher high. And we're anticipating the MACD where anticipation, right? Remember we talked about that turning and coming back up at this point. So we could be buyers in here. This could be an opportunity for us to buy Super Micro. How much money we got left? We got $50,000 sitting on the sidelines. Let's put a little money in here. All right, let's come in here. We'll just do a starter. Let's come in here and do $1,000. 79, 1,000. Let's do 40 shares. 40 shares, $1,100. We're going to go ahead and just put those in the market right now. But I'm going to come in and I'm going to put the other 40 as a limit order down here. If it comes down and tests this 78.6 one more time, I'll put that other 40 right there, just as a limit order. So do a little dollar cost averaging and anticipation. And then if we might put a stop down here at the head. If it's, you know what? If this gets filled, we'll have 80 shares. We could buy a put option. That'd be close enough. We'd buy a little further out, so the delta's at 80 or even less than 80. So we're not covered 100%, but we would be okay. We could do that. Let's do that. That sounds like a good idea. Of course it's a good idea. All right, SPX. I don't want to do anything here. We already got our little position up here. Collected, received 3,000. We're up 115 bucks. We paid 3,000. This is just a little game we played here. Let's just go in here and liquidate this. Let's just come in here. Options, take our profits. All right, exit all options. It's not going to let us. Oh, it did let us. All right, we're out. Would you like to close the position stock orders? No. Okay, so we took our 115, close the position on that one. We took our 80 bucks, $80 on the SPX. All right, so now we come down here and Tesla is making me very sad. Why? Because I had some Tesla and I was long Tesla. It come flushing out like a toilet on us after that last earnings. TSLA. Just because you like Elon doesn't mean he's got a good stock. But it is. It's a B stock. That's good. Better than most of the ones we've seen. It's worth $712. It's trading for $300. 4,226% overvalued. Even Graham has it only at 23. Take 285 years to grow into it. Look at that. It was right here at this almost exact price last year. It went all the way up. We rode it all the way down. We got in right here, rode it all the way up, made a bunch of money, and hang on to it. And now we're losing money on our winning trade. Turned a winner into a loser. LAN. Just because you like your Tesla and just because you like Elon doesn't mean that you need to let that become part of your trading strategy. Severe overvalued. They're making money, though. Look at this. They anticipated to make money. They lost money this year. So far, they're down. They're anticipating to be losing money over the last 2 years. Do they have a little BS going? Not too much. They're not buying their shares back, at least. But look at their earnings per share is going way down. I'll bet he starts buying the shares back. I'll bet he does. Well, I don't know if he will or not. He doesn't have any cash. He's got a big bet on robots, and he hasn't been able to get them released. So he's years behind in his robots. And he's stopped selling 2 car brands because of his robots. And so it's hurting him. Hasn't been able to get his robots out. And everybody else, all the other companies got robots. You know, Chinese have got robots. You see them on YouTube all the time. Well, look at what the robots are doing. And none of them are Elon's. Okay, let's go back over here. I am suffering with Elon on that one. XLC. Oh, my goodness. Look at that. Communication Services Select Spider Fund. This is the communications, right? So that's a good sign. That means AT&T. We should be looking at AT&T and Verizon. T and VZ. T and VZ. That's got this bad tick in there. And I've tried to That's on everybody has that tick, and I think that's bad data. Now, one of the nice things about track and trade is we can go in and fix that ourselves. You want me to show you how? Come in here to data, and we're going to go into underlying data. I think you do the underlying. I think. Is that right? I think. Yeah, I think the underlying. So this is January 8th of 2026. So we come down here and find January 8th of 2026. January 8th, 2026. It's way out of whack right there. So I'm just going to use the close, the low from the low and the close from the previous bar. Oh, let's do it from the next bar. 8th to 9th. Let's go, yeah, let's put that at 39.77. 39.77. Oh, I got to put a period in there. A dot. 39.77. And then we're going to put this one here at 39.77 as well. Are both of them the same? Okay. All right. So you see how I fixed that? I fixed that data. Now that was a bad tick, and we know that was a bad tick. And so it screws up your chart. Now, if you throw away your cash, so if you come up here and, go into File, Edit, Manage Local Cache, and you delete Verizon, because the exchange is the one that's got the bad data, they'll send that bad data tick down to you, and you'll have to go do this again. All right. But as long as you keep it, it'll keep it like that. So we can fix a bad tick in track and trade. That's a really nice feature. Okay, so now all the indicators are correct because all the indicators were taken in that bad tick too. So you don't want to do that. You want to kind of get rid of that. I just washed it out. All right, so this is Verizon. Oh my goodness, we're missing the opportunity in Verizon. We know Verizon is a good company. Look at this thing take off like a rocket ship. It got beat down really bad because everybody thought SpaceX was coming out and SpaceX was going to take all Verizon's business. Same with AT&T. Everybody thinks, and look at AT&T. Where were we? Sleeping on the job. Remember when we were talking about these companies? We're like, man alive, these companies are great. We're putting them in our portfolio. Look at that. It's a B company. This is AT&T. It's a B company. Look at that. It's trading it's worth 33. It's trading at 24. It's still below value. And look at what it was. We could have bought it clear back here at 21. We could have bought it at 21. It's at 24 now, and it's worth 33. So it's trading 26 right now. Even after that big run, it's still 26% below value. And it's a good company, B company. Their revenue's a little bit down, but it's nice and flat. Look at that. They're buying their shares back a little bit. Not too bad. They're just running through a little rough time right now. But that's a good company. We should have been buying that one. It was down. Look at the MACD. Look at your MACD. Yelling at you. Land, buy that. Buy that baby. Can't buy it right now. Look at the RSI, way up in the overbought region. Way up there. See RSI? That's our RSI right there. And it's above 70 by a long ways. We got to wait for that to dip. Technically speaking, you want to be buyers when that thing's down here below 30. All right. Yeah, we talked about T-Mobile. Let's pull up. What's T-Mobile's symbol? Do you remember? TMOB or something like that? I can't remember. We'll go look it up. What is their symbol? What's T-Mobile's symbol? T-Mobile is TMUS. 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 I remember looking at this with you before, James, right? That's a B. So it's worth 105. It's trading for 184. So it's a little bit expensive. It's 74. So T-Mobile, and it's still, it's starting to rally a little bit here, but T-Mobile, they're buying their shares back to prop up their earnings. So they got a little BS going on here. They got a little BS going on there, James. So it says they'll never catch up at this rate. They're over by 74%. That's AT&T. Did we pull up AT&T over here? Nope, we didn't. So there's AT&T. They're a B2. They're valued at $33 a share, and they're trading at 24. So they're still 26% undervalued. And that's because of SpaceX. But I don't think SpaceX can be taking their business anytime soon. I mean, maybe a little, but look at that. Rocket shipping off the bottom of that thing. It was down 30%. Okay, so what do you want to do here? Well, we don't want to buy right here. It's bouncing off of those moving averages. Let's see if we can't get a dip. Let's turn off Heiken Ashi for a second. Ooh, we got a dip here. We got a dip here. We're getting dipped today. All right, let's cross our little fingers and toes. That's what we were looking for. We're kind of looking for a rally. Let's see if we can get an ABC out of it. Let's see if we can't get this thing to come back like this and then anticipate a continuation. This would be a great stock to have in our portfolios, I think. I don't want to get too heavy into it, but I mean, too heavy, all because we have T-Mobile, AT&T, and Verizon. All, if we put all three of those in there, that'd be too heavy of a weight. Which one would you want to take out? Let's go to our portfolio. Let's clean our portfolio out. Let's add. Oh, we gotta go to Analyzer. Let's add that to our portfolio. So we're gonna add to portfolio AT&T. Let's put Verizon in there into our portfolio. Okay, add to portfolio, and then we're going to put TMUS, TMUS, T-Mobile. All right, so we're going to add that to our portfolio. We're going to come over here and compare them. Compare and contrast. All right, drop down that, and let's take a look. So we got Verizon is doing the best. It's coming back a little bit better. See, they all start out at the same spot. So today, Verizon is kicking their butts by 20%. T-Mobile is in second place, and TMUS is down 7 on the year. So I think, James, buy low, sell high. The other two have already taken off. Buy the lagger, right? Buy the lagger, because the lagger will probably follow. And the lagger is T-Mobile. So that's the one we want to buy. So we're going to come over here. We're going to go to T-Mobile. Buy the lagger, because he'll probably follow the rest, follow the others. TMUS. That's our opportunity. There's our dip. There's a rally. There's the dip. That big bump right there is kind of, watch this. We'll move that out of the way and watch what happens. Well, it's not that big of a bump. Okay, let's buy it though. That's the one we're buying right there. It's the first green candle. It's making a green candle today. Let's come in here. We're not going to back the truck up for it, but we're going to put the others have already taken off. And this one dipped harder, has already dipped. The others didn't. This one led the way, actually. Went before the other two, didn't it? Now it dipped. So we expect the other two to dip. We can buy this one. How many? We don't want $92,000 worth of that baby. It's worth $184,000. Let's put in, we got $58,000 left. Do you want to put in $4,000 right here? Let's put in $3,000. $3,000. Now, this is what I'm telling you. We're sitting here randomly pulling these numbers out of our hiney. How much are you going to put in this? I don't know. Let's put $3,000. This is what Portfolio Matrix does for you. It tells you exactly how much to put in here. You put that in your portfolio, it'll tell you exactly how much to put in here. It'll tell you when to buy. It'll tell you when to sell. It tells you all that kind of stuff. It tells you how to accumulate. That's why we need Portfolio Matrix. But today is not a Portfolio Matrix day. Today I'm just pulling things out of my hiney because we're just doing MACD and stochastics. So let's come in here. We'll do my market. All right. So let's come back over here with the last one. Oh, we already did Tesla. Verizon. Oh, see, Verizon. Beautiful opportunity, and we didn't take advantage of it. Look at the MACD yelling at you. Buy that land. Buy it. Buy it. Buy it, land. Buy it. And then we got the XLC, which is down here. We already bought some of that. We can buy some more. So I guess we did kind of buy AT&T, and we did buy T-Mobile, and we did buy Verizon because we bought some 47 shares of the XLC, and that's what XLC is. So we're going to buy some more. This is first green candle, make a new high. We did 47 last time. How much is that? $5,000. We're going to put $5,000 in there again. I guess we can buy market. All right. So now we got 93. Look, if we do 93, let's do 94, 95, 96, 97, 90, 93. We need 7 more. 7 more. So we'll buy 7 more. Now we got 100 shares. Let's come in here and let's come in here. Let's do 52 days. We'll go over to our options chain, 52 days, and let's hope we can get a, look how thin they are on the volume. Open interest is really good. We've got to buy a put. Let's see, buy a put. Let's just do a little protection over here. Let's just buy our little self a little bit of insurance policy. 150 bucks. That ain't bad, right? Ain't bad at all. $150. Actually, theoretical value is only worth 123 and we're paying 150. That's not good. But we got some volume there. I think we can buy this one. Let's go ahead and I'm just going to mark it into it because it's demo account. That would be a good position though. Now we're protected to the downside for the next 52 days. Put a little collar on that thing. So we got our 100 shares long. I think that's a good trade right there. And we're protected to the downside with nothing more than a $170 insurance policy. All right. That's a good trade right there. I think that's a happy one. Well, I think we feel good about that. All right. That's it, guys. That's our portfolio. Now what we should really do is we should take these, and I'm going to come over here. Let's how am I going to get this out of here? Let me hold on a second. How can I do this? Okay, I'm going to take this off screen just for a second so I can go fast. Just so I can go fast because I'm fast typist. Let's come in here. Well, it's not going to let me do it that way. In Portfolio Matrix, I have to do them one at a time, or in fair market value. We're going to add these all to our portfolio. First of all, we're going to go into our portfolio. Let's bring this back up. I want to get all those into the portfolio, and then we're going to push them over to Portfolio Matrix. And it'll tell us how much money to put in each one. So we're going to come in here, and we're going to go Portfolio. And I got these three. And do we have AT&T, Verizon, T-Mobile? I think we're only doing T-Mobile, right? These two we don't. We have T-Mus. So we're going to go T-Mus. And, okay, we're going to add Apple. We got Apple in there, AAPL. And we're going to add that to our portfolio. We're going to go Amazon. I can tell you right now, we're probably add to portfolio. We're way too heavy into the tech sector. APLY. Oh, it didn't like our APLY. Are we in? Oh, we're not in Amazon. APLY we are though. APLY, and it wouldn't let me APLY. Oh, that's why. That's because that's that Yield Max Apple options. They're doing covered calls on that. We can't put that one in there. We can put it in there. We just can't put it on fair market value because it's not a stock. It's an ETF. BX. Blackstone. Come on. Add to portfolio. Okay. Blackstone CRM. Salesforce. Add to portfolio. I got to make a faster way to add these to portfolio, don't I? GOOGL. Alphabet. Add to portfolio. HIMS. No, we're not going to put that one in there. INTU. Add to portfolio. INTU. MSFT. Microsoft. Add to portfolio. MSFT. I wonder if I can do it. MSTR, MSTY. What would that do? Oh, no, don't like it. MSTR. Oh, come on. I know we got that in there. MSTR. Oh, you rotten dog. Oh, well, that's our other one, Bitcoin one anyway. That was when we don't have anything in there. That was for our Misty. Oh, and we can't do Misty either. So we got to MU. MU. Come on. Micron. Come on, Internet. Add to portfolio. MU. Nike. NKE. Nike in there. Oh, why did it didn't like Nike? I think we wanted Nike though, didn't we? Yeah, we got Nike. I gotta write that down. Nike's one we got to put in. NKE. All right. So Nike, and we're going to do NVDA. Add that to our portfolio. Add to portfolio. ORCL. Going to add that to our portfolio. SCO. Nope, not that one. Shop. HOP. Add that to our portfolio. We don't have anything in Shopify. What did we decide to? Why are? Ooh. Oof. Missed opportunity. Let's leave it in there. Okay, so back to this. We'll leave shop in there. Did we add that to our portfolio? Yeah. Adding. Okay, shop and the SM Energy. Add to portfolio. Oh, we still got a few more to go. Super Micro SMCI. Come on. I'm going to fix this. I got to write a note. Okay. Add comma separated to portfolio. So we can just type in a whole bunch of symbols and get them in there. SMCI. Where do we get to? SPXT. Are we going to put T in? I think we are, right? We're going to add that to our portfolio. Are we going to get heavy into that? T must. I think we already have that. In portfolio. So that's already in there. T must. Tesla. Are we going to add Tesla? You got to buy low, sell high. Tesla. Add that to our portfolio. Verizon. Lan, why are you putting Tesla into your portfolio? The stock sucks. You're letting your add to portfolio. Emotions. Put a stock in there that shouldn't be there. All right, let's go to our portfolio. 17. Let's bring that full screen again. So we've got we got 2 Ds, Oracle and Tesla. Those are our 2 Ds. Oh, we got 3 Ds. BX. That's what's BX? Oh, that's Blackstone. Why are we putting Blackstone in there? It looks like a good recovery. Looks like a buy low, sell high opportunity here. Overvalued 8. Oh, oof. Worth 133 D. What are we doing with Blackstone? AB Blackstone. Oh, well, they're on the rise. We're making money. We got our order sitting at break even. We're up $188. We only put 17 shares in them, but we're in them. All right. So that's our portfolio. Do you want to trim it? Which one would you take off? What do you want to trim? I don't think we trim any of them. All right. So let's go over and prep. Let's go over to Portfolio Matrix. Log in. Come on. Go over to Portfolio Manager. And I am going to YouTube paper trade. SFO FMT basket. That's our fair market value basket. This is the last one, fair market value basket. That's the last time we did it. That's the ones that are already in there. Let's just go ahead and let's delete the group, keep the content. No, delete the group and the content. Are you sure this will ever? Yes, let's kill that one. Okay, and I'm going to put it, let's see if we can, okay, this is the other one we got in here we're messing around with. Let's go ahead and kill that one too. Delete group and delete the content. So that one's gone. Okay, so now what we can do is we can come back over here to, where'd it go? Oh, right here. Fair market value. Now this is our fair market value. And if we don't want to, if we want to keep all those, we don't want to get rid of them. We decide we got all these. We just come in here and we hit add to portfolio matrix, PMX. Boom, just like that. Put in my email address, lhturner@gmail.com. Okay. All right, sent to SFO basket. All right, that's how we get it in here. So now, oh, not in here. That's track and trade. Now we get it in here. So now it should show up in here. Let's see if we have to hit refresh. Doing hard math. Okay, Robinhood, not you. We don't care about you. There it is. All right, now we should be able to drag this. I really want to put it into, see, we got SPY and Q up here. And then I want to take this one. I think I can put it like right there, just like this. just like that. Okay, there's our portfolio. So we've got SPY, QQQ, and then we got our nice little beautiful portfolio. So those are all the ones that we put in there. So now what we want to do is we want to come over here and we want to set targets. How do I set targets? I got to go to Portfolio Planner, I think. No, I already did this one. I got to go to Portfolio Manager. Not that one. I told you not that one. Not this one. This one. And this one. Okay, apply goal. Oh, no, we don't want to apply goal yet. Doing hard math. Okay, I want to actually customize it. So we're going to come in, we're going to use the PMX core. So the PMX core is the one that buys low and sells high, which is what we're doing with our over in track and trade, only we're doing it like pulling it out of our hiney, right? So now we're going to come in here. I'm not going to turn Mac. We're going to look over let's look over the last 1 year. What our portfolio has done over the last year, projection horizon. We're going to go out. Let's go out 5 years. Initial investment. We're going to put I don't have 250. My portfolio's dropped to 150,000 now, but it's going to come back. So I've lost 50 grand on that stupid. Some of it was on Tesla, and then some of it was on, but most of it was in crude oil because the bomb Iran. So they start bombing again. So I had to wait for crude oil to fall again. I had all my money. I had over $200,000 and I didn't take it. I was going to, but I didn't. All right. So reoccurring investment, $750 a month. Now, where's my reoccurring investment coming in? My reoccurring investment is coming in because this is an IRA that I'm putting this into, and I have the ability with me and my wife, 8,000 plus the 1,000 catch-ups, 8,000 plus, let's say 9,000 each, 9,000 each. Oops, too many. 9,000 times 2 is 18,000 divided by 12. See, that's 1,500. So technically speaking, I could put $1,500 a month into here. Okay, and then that's going to be recurring investment going in monthly. And then we're going to drip, because there's very little. I always tell people don't drip, but in this case, I'm going to drip because this is not a portfolio that's got a lot of dividends. Oh, well, it's got 1.2% dividends. That's not bad. Okay, so let's apply the custom strategy. All right. So the custom strategy says that we should put in Google 8.82%. See, so we're not going to be pulling it out of our heinies anymore. So where's TMUS? TMUS is right there. It's saying we should put 4.9% of our $150,000 into TMUS. So the price gain, now this is going off of last year. Past performance not necessarily indicative of future results, but it's the best we got. So last year, the price gain for the past performance was $64,000 or 38. It was up 38%. Our dividends were 17, and we made 40% annualized return. This portfolio, had we bought this right here, right? This portfolio did this last year. That's what it did last year. So we can project the performance, and this is the projection for next year. If we do this, they're saying 200 optimistic or expected 400% return. I don't know. That's a little optimistic to me, but it's taken all this into consideration. It's going to do that again. I don't know. They're going to do that again. I don't know. Let's not hope for that. Let's just hope for it and not trust that it's going to do that again. All right. So those are all of our portfolio things in there. Now what we want to do is we want to come in here and we're going to invest this strategy. And it's going to tell you the exact dollar amount to put into each one. Run a calculation to view the results. How much? We're going to put all 150,000 in there all at once. Allow selling? Yes. Sell profits, sell losses. Should we let it sell loss? What if we said we don't sell profits, we only sell losses? Only sell losses. I don't know. Sell both. We could run it both ways and see. Full rebalance, I have read. Okay, create. That's how much money to put in these. Now, how much were we putting in? We don't know. We were just pulling money out of our hiney, right? But this is how much to put in. TMUS says to 7,350. Apple 9,300. Amazon should have 10,000 in it. BX should have 7,000. CRM 8,000. Google should have 13,000. Intuit should have 4,000. Microsoft should have 8,000. And this is optimized based on past performance and where the markets are currently at, because that's what that core does, is it looks at the buy low, sell high, and it ranks all those things, and it tells you where those things are at in those dips and valleys. And the idea is to buy low and sell high. We're allowing it to sell our profits. We're going to sell high so that we can buy back low. So we have money to buy back low. Plus, we're putting money in. So we're going to sell our losses and we're going to sell our profits. What if we don't sell losses? No selling losses. Let's calculate that investment. So that's what that's going to look like if we don't sell our losses. We only sell our profits. But we can just let the computer do both, whatever it wants to do. And then we're going to put that in there. There you go. That's your portfolio rebalance. And then every time, now here's what you do. I've been studying this really hard so I can share it with you. So I read it so you don't have to. So what you do, anytime you change anything in here, anytime you take Microsoft out and put something else in, or anytime you put something else in, you have to retarget. So that's to set the targets. So as long as you keep the portfolio exactly the same as you have it here with the same number of things, you don't retarget. You only rebalance. Now you can set your targets every quarter if you want to, even if you got the same ones, you can go in and reset your targets. But we don't set our, you don't need to set your targets unless you change something. But every time you change a stock, Uncle Tom tells you, hey, Mr. Land, you should have this stock in your portfolio. Okay, I'm going to do that. And you put it in your portfolio. Well, now you have to reset your targets. But otherwise, you just rebalance. So every time you add money to the portfolio, or every week or every month, there's no right answer. You can rebalance as often as you want. Those yield max funds, they rebalance every week now. They used to do every month. Now they do every week. So you can rebalance every week if you want to. Rebalance every week, rebalance every month, rebalance every quarter, however you want to do it. And then the problem with saying, well, what's the right answer? Well, there is no right answer. You don't know until hindsight. Hindsight's 2020. It tells you, well, if you'd have rebalanced more often, you'd have been better off, or if you rebalance less often, you'd been better off. But you don't know that until it's already happened. So you just you have to just pick one and do it. And I don't know, do it whenever you feel like it. Oh, I didn't rebalance last week. I guess I'll rebalance now. So you just rebalance, and then you adjust your portfolio and move the money around. So that's how you do it. Then you rebalance. And then every time you change your portfolio, set your retarget. So you come in and retarget. And then you customize the strategy, and then you just apply the custom strategy. That's setting your targets. So you set your targets. Those are your targets. And then you say invest. And it's going to give us the same numbers because we didn't change anything. But there you go. That's how you get it. Now you know what numbers to put in and how often to do it. And then if you decide you want to change up your portfolio, you come over here, or you come over here, and you start looking around for different. I don't want Tesla anymore. I don't want Oracle. I don't want BX. If you take those out, boom, boom, boom. You could send this back over to Portfolio Matrix again, but at some point you're going to start using real money, right? And then you're going to have real money in here. And you're not going to be using this because this will then connect to your brokerage firm and tell you what your real money is. Now, it won't trade for you yet. Maybe someday in the future, that'll be a feature that you can just push a button here and it'll and rebalance everything. I would like that. I think that would be really cool. It would be a goal that we should work towards. But right now, it just tells you how much to put your money, and then you go over to your own brokerage firm and put it in, connect this to your brokerage firm. It can read your brokerage firm, but it can't write to it. So at that point, it tells you what's in your brokerage firm. And it tells you how much money to put in your brokerage firm. I'm just waiting for my money to come out of this stupid crude oil trade that I got all my money tied up in crude oil right now. And when I get that, I'm going to put it in here, and we're going to trade my portfolio, which was 200,000, and now because of crude oil, it's down to 150,000, 50 grand down on stupid crude oil. But it'll come back. We'll wait till the war's over, right? It's got to come back. All right, guys, that's all I got for you, which is plenty. I think we're here. Been here a long time, 2.5 hours. That was a long class. So if you guys have any questions, please let me know. If you want Portfolio Matrix, just go over to, how do you go to Portfolio Matrix? Go to subscribe and click this button right here, sponsored link. Click the sponsored link and you get it for, It's generally, what is it? Sponsored link. Go there. That's my sponsored link. So it's generally, if you go to the Portfolio Matrix website, it's $36.99 a month. But if you do it through SFO Magazine, it's only $26. Saves you some money. All right. And then if you do it through SFO Magazine and you subscribe, when fair market value gets released to the public, you get this for free. But you have to buy, you get this fair market value for free, but you have to buy Portfolio Matrix through this link. All right. So through this link right here, hit subscribe, click this link right here. You buy that. That means that's going to help pay for your Portfolio Matrix, which you're going to get fair market value for free right there. All right, guys, if you have any questions, please let me know, and we will catch you later. Sorry it was so long, but I think it was, you know, stuff I was going to do anyway. Might as well watch me do it. Okay, we'll see you. Oh, let's see. I got to do one more thing here. What have I got to do? I got to pay the bills. Let's do this one too.
Okay, this is the software I use. It's called Track and Trade. They've got two versions, one for stocks, one for futures. This is the website, track, the letter N, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
Okay, take care, guys. We will see you tomorrow afternoon, and we're going to do Power Hour, and we're going to do a little day trading.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.